Okay, good afternoon, everyone. Welcome to Baiju's Exam Prep IAS. This is Sham Kagod here. Now, before I start the discussion, if there is no issue with the sound, please do let me know. Give me a thumbs up. Okay, now, done. Thanks a lot. Let's start. So, today we are supposed to start with the discussion on the financial market. In the sense, half of the financial market we have covered last week. We are supposed to continue with that particular discussion. Now, before I start the discussion, let's start the usual ritual, the usual convention that we have been following for last couple of weeks. List of the articles that I feel you must read. You must read for the last 1 week, which have appeared in different newspapers. This one is an article from Hindu newspaper. I believe it appeared on Monday or Tuesday last week, which talks about the cooking strategy. That is basically subsidies for cooking fuel. Second one is today, I believe we have already covered the concept of Pradhana Mantri Janadhan Yojana. Let me know, yes or no. We have covered already the concept of Pradhana Mantri Janadhan Yojana, PMJDY. If you ask me, sir, where have you covered it? I believe we have covered under the concept of banking sector, financial inclusion. We are going to complete, right? We are going to complete around 7 to 8 years of Pradhana Mantri Janadhan Yojana. And as a result of this, we are going to cross more than 50 crore bank accounts under PMJDY. So this article discusses what is the importance of PMJDY, etc., etc. Okay, so please go through this article. And those students who are saying this is the first class, please do not worry. Next time, whenever the economics classes are there, please attend. You will learn all these concepts. Right? We have covered many of these concepts in the earlier weekend. You might have not attended those classes. Do not worry. You have the schedule for the full year. Wherever the economic classes will be there, please attend. We will cover all these concepts again in those classes. Third article from Economic Times, several districts in India which do not have banking presence. And now, if you remember, when we discussed the concept of banking, I told even after so many years of independence, 75 years of independence, I said even today all the villages in India do not have the banking branches. Yes or no? Did I say this when I discussed? If I have not told this, please do correct me. I don't have any problem. Okay. I would have told you, even today, after 75 years of independence, we do not have the banking branches throughout India. And that is the reason why one of the restraints, or let's say one of the constraints regarding the promotion of concept of financial inclusion. The writer is a Rajya Sabha MP, right? So please understand, writer is a Rajya Sabha MP. So obviously, right, they will have information regarding various committee reports, etc. So there is an article about the presence of banking sector in various districts. Please go through that. So one student says, good evening, my dear. It's not good evening, good afternoon. Good afternoon. Okay, 12 o'clock after 12 p.m. Good afternoon. Okay. So next, last week did we discuss concept of certificates of deposit? Let me know. Simple question to all of you. Last week, did we discuss the concept of certificates of deposits or not? One of the components in the financial market. Right? So this is the article regarding certificates of deposit. Please go through this. Okay. CD is a certificate of deposit. National Food Security Act, we'll cover it today. Today or tomorrow, we'll cover the concept of NFSA. Please don't worry. We'll have a discussion. Then you can read this article. Right? Again, from the parliamentary discussion, there is one article. Today or tomorrow, we'll have a discussion regarding World Trade Organization. Right? World Trade Organization. Right? Either today or tomorrow, we'll have a discussion. And what is the issue regarding the food security, public stock holding, right, as well as these particular points. Right? So all these we will cover it. After that, please read this article. Okay. Next, right. Next article is regarding IFCO. Right, IFCO, right, a very famous fertilizer company in India. When we discuss agriculture sector, which I believe we will have a discussion tomorrow. Right, we'll have a discussion regarding fertilizer. Let's say the drone sector, agriculture sector tomorrow. After that, you please read this article. This becomes relevant from that point. Right, agriculture related article, concept of ENAM, recommendation regarding ENAM. Right, please read this tomorrow once we finish agriculture sector. These couple of articles are related to agriculture sector. Please read after that. This one, Ujjwala scheme, for the first time ever, The refills in the LPG have actually gone down. So this article becomes very important from that context. How much subsidies are provided? What is the issue, right? What is the Ujjwala scheme, etc. Right? Again, when we cover subsidies, after that you read this article, you'll understand what I'm talking about. Okay, again related to agriculture sector, urea. Please read this tomorrow. Right? Internam, intermandi, enam related to agriculture sector. Again, agriculture sector. PLI, will cover PLI under industries. There are certain very important industrial policies of Government of India. Have you heard of Startup India? Let me know. Have you heard of Startup India? Have you heard of the production linked incentives? Have you heard of Make in India, etc.? So there are various important policies or schemes of Government of India. It is not sufficient that you by heart the provisions of the scheme. You can simply by heart. I know that. Right? Many of you will simply by heart the provisions, the points regarding the schemes. So there are various schemes regarding which you need to understand what are the important areas they are covering, what is the importance of the scheme, what has been done so far under the scheme, what has been right the outcome of the scheme, has it been successful, has it been right a failure, etc., etc. So there was an article regarding PLI. I'll give you many more right next week and the week after that. That will be the last class for you people. I'll give you many more articles regarding PLI which have come right in many more newspapers in the last 1.5 months. Another article regarding PLI. Don't worry, when we discuss PLI, please read this. I hope you understand. Don't tell me, sir, you have not covered PLI. I know that. I expect the PLI to be covered either today or tomorrow. Once it is covered, read it. If it is not covered this week, pakka it will be covered next week. You can read after that. Please don't worry. Okay. Next one is very recently there was one report by an agency which connects the Manrega with Pradhan Mantri Janadhan Yojana scheme. Right, Manrega as well as Pradhan Mantri Janadhan Yojana scheme. Please read this article. Please read this article. Right, again, don't say, sir, in economics we are not covering all of this. My dear, can you cover, right, let's say a connection between Manrega and PMJDY under social issues? Can you talk about Manrega as well as PM Jan Dhan Yojana under the budgeting, that is a concept of gender budgeting? So there are various ways you can connect these dots into either social issues or into essay paper or into GS paper 3. So that is the reason there is one more article. Please read this. Digital crop survey, this was in the newspaper yesterday itself. Digital crop survey, which was there yesterday in Business Line. Please read that. And this was also there in yesterday's newspaper. How many of you were able to read this article? Fitch's US downgrade rattles Indian equities. Please do let me know whether this was a very important newspaper article yesterday, day for yesterday. Were you able to read it? If you have not been able to read it, read it. Today we'll discuss what is the concept of credit rating. I have not yet discussed that. I know that. Today we'll discuss. Then you read this article, you'll understand it. Done? So I've given around, right? I've given around 16 articles from the last 1 week. 16 articles from the last 1 week. Now, in the last week, some of the students said, sir, whatever articles you are giving in the PPT that we download, there is no clarity, right? Can you just assist us? For this purpose, right, listen to me very carefully. There is a separate link which will be provided to you. In today's class only, there will be a separate link provided to you. It will be uploaded in the comment section, right, of your class. Please download using that link. Am I audible to all of you? Am I clear to all of you? Please do let me know. What I'm saying is, all these articles will be separately given to you in a link. It will be posted in your comments section. Use that link, paste it in your Internet Explorer, right, or Chrome, or whichever, Firefox, or whatever, right, let's say Explorer you're using. Download those articles. Right, these articles anyways will be there in annotated PPTs, but apart from that, if you want much clearer pictures, it will be given in the form of a separate link. You can use that link. It will be uploaded in your comment section very soon. Don't worry. Done. So let me start. Financial market. With this caveat, let me start. Okay, financial market. Now, what is the financial market? What we have covered in the last week regarding financial market? Financial market basically, It's a market where instruments are traded. Correct? It's a market where instruments are traded. Instruments means what? You will trade corporate bonds in the market. You will buy and you will sell. You will trade, right? Let's say shares in the market. You will buy, you will sell. So whenever the instruments are traded in the market, this market is called as a financial market. Point number one. Now the financial market is basically broken down into two components. We have covered all of these last week into two components. One is called as a capital market. Second one is called as a money market. Capital market is the market where the borrowing or lending will take place for more than 1 year duration. Right? I'll repeat it. Where the borrowing or lending, meaning what? The instruments which are used in the capital market will have a duration of more than 1 year. And in case of money market, the instruments which are used will have a duration of less than 1 year. In case of money market, we have discussed what is a repo, what is a reverse repo, what is a call money market, what is a commercial paper, what is a certificate of deposit, and finally, what are commercial bills. Now, please let me know whether this statement makes sense or not. Can I say most of the RBI's instruments under monetary policy, they will fall under the money market? Let me know. Again, I'll repeat the statement. The RBI's monetary policy instrument, don't you think they will fall under the money market? Yes or no? Right, sir. Right. What do you mean by RBI's monetary policy instrument? Best example is repo rate and reverse repo rate. Those who are saying no, please tell me what is the reason. Those who are saying no, please tell me what is the reason. The most important tool used by RBI is what? Repo and reverse repo. And instead of reverse repo, now we have a standing deposit facility. Right now, what is the duration for repo, reverse repo, standing deposit facility, or even marginal standing facility? Right? Don't you think these instruments, repo, reverse repo, STF, MSF, etc., etc., right? Basically, it is for a short duration. Correct? Basically, it is a short duration. And when there is a short duration, is it a money market or a capital market? Because it comes under RBI Uber platform, Kuber platform. My dear, platform might be named Kuber. Please understand, platform name might be Kuber. But tell me, under repo rate, will you borrow for, right, let's say 1 year duration, less than 1 year, or more than 1 year duration? Money market is not name of a platform. Some of you make a mistake here. Understand the logic behind it. Do you think money market is a name of a platform? No, money market is not a name of platform. Argument is, under repo rate, will you borrow for less than 1 year or more than 1 year? Think of it. Under reverse repo rate, will you borrow for less than 1 year or more than 1 year? Under STF, less than 1 year or more than 1 year? All of them are less than 1 year. What about MSF, marginal standing facility? Less than 1 year. So can I say these are the instruments which can be used under money market by RBI or banking sector? Correct or not? These are the instruments which can be used by RBI in the money market by, right, these can be instruments used by RBI through the banking sector in the money market. Of course, yes. Right, less than 1 year. That is the point here, less than 1 year. Right, if it is more than 1 year, of course, yes, it will become a capital market. For example, what about government bond market? Please tell me. What about government bond market? The government bond market will come under the money market or capital market? You tell me. The government bond market will it come under the money market or capital market? Right. Basically, it will come under capital market. Why? Bonds will have a maturity period of more than 1 year. Yes or no? Bonds will have a maturity period of more than 1 year. And because they are having a maturity period of more than 1 year, they will have to come under the concept of capital market. Again, please do not be confused. It's a very simple concept. Please do not be confused. Okay, now let me go forward. Last week, right, did we discuss IPO and FPO? Please do let me know. As far as I know, this is where we stopped last year. I said last week, not last year, last week. My mistake. Last week, we discussed what is IPO. We discussed what is FPO. What is IPO? IPO is basically initial public offering. Meaning of initial public offering is this company until now, the shares of the company were not available in the market. I repeat, the shares of the company were not available in the market for trading purposes. For example, please tell me now, right? Can you go to the stock market and purchase the shares of a Zomato company? Think of it and answer. Can you today, right today, or let's say next week, whenever it is, can you purchase the shares of Zomato company? Can you purchase the shares of Paytm company? Or the best example in the current affairs, nobody should have a doubt. Can you purchase the shares of Adani company? Can you purchase the shares of Adani company? Right? Let me know. Arre Baba. Some of you are saying no. Why? Some of you are saying no. Why? Don't you think the shares of Paytm you can purchase in the market, provided you have money? Right? Don't say, oh, I don't have money, what can I do, etc. etc. Not about that. Are these shares available in the market or not? Of course, yes. Right? If you have money and if you're interested, can you purchase? Yes. If you're not interested, can you sell them? Of course, yes. So can I say all these companies whose shares are available in the market, they have already conducted IPO? Let me know. All these companies whose shares are available in the market, can I say they have already conducted IPO? That is the basic idea. So IPO means the shares of the company are available in the market, right? You can go to Bombay Stock Exchange, purchase them, or you can purchase the shares from the National Stock Exchange, BSE or NSE. So whenever shares are issued and investors will purchase directly from the issuer, will call this as a primary market. I'll repeat it. Whenever the instruments are issued and you purchase directly from the issuer, this is called as a primary market. And when you will sell these shares to other investors or you will purchase these shares from another investor, this is called as a secondary market. And this is nothing new to you people now. Earlier also we have discussed concept of primary and secondary market. I'm just revising it for you. Right? Primary is where the issuer will issue the instruments, whereas secondary is where instruments which are already there in the market, you will buy them or you will sell them. That is called a secondary market. Now, just to make it much more clear, let me ask you a very simple situation. Answer to my question now. Answer to my question. Government of India through RBI will sell bonds to you people. Is it primary market or secondary market? Government of India through RBI will sell, right, government bonds to you people. Please answer, is it primary market or secondary market? Primary or secondary? Those who are answering secondary, please tell me why it is secondary, because this is primary market. Those who are saying this is secondary, please tell me why this is secondary, because answer is it is primary market. And this is very surprising because did we not discuss this under Reserve Bank of India? If not, please tell me. Those who are saying it is secondary, did we not discuss this when I took up the discussion on Reserve Bank of India? If you don't trust me, some of you will not do that. I know. Some of you are here to play devil's advocate. Devil's advocate means question everything. Please open the chapter banking. Please open the PPT for banking. Please check one of the slides. I would have discussed all of it. There will be annotations regarding this. Please check it. Let me ask you one more question. Reserve Bank of India will purchase bonds from you. Primary market or secondary market? Reserve Bank of India will purchase bonds from you. Right? Let's say government bonds. Primary market or secondary market? Arre Baba. This is very interesting. Some of you are saying primary. My dear, this is secondary market. Who is the issuer of government bonds? Arre Baba, why are you making it so complicated? Why are you complicating it so much? Who is issuing government bonds? Government bonds are issued by Government of India? Yes or no? Government of India will issue government bonds. Issue in the sense who is printing. Those who are saying, sir, RBI. RBI will not print government bonds. Government will print government bonds, hand it over to RBI. Hand it over to RBI. So please tell me who is issuing government bonds. Government of India will issue government bonds. So when RBI will purchase it from you, is it primary market? Is it primary market? No, this is secondary market. This is secondary market, right? Let's say you will sell the shares of Adani company to me. Let me see. You will sell the shares of Adani company to me. Primary or secondary market? Check it. Right? Please look into it. Right? Don't make a mistake here. This is secondary market. Some of you are saying primary here also. How? How? Those who are saying primary, how, my dear? Who is the issuer of Adani's shares? I don't understand. What is the difficulty in this? What is the difficulty? Who is issuing Adani shares? Issuing. Don't say me. I am selling shares of Adani. Can I say Adani company will issue the shares of Adani company? Yes or no? So I have purchased the shares of Adani company. I will sell it to you. Or you have purchased the shares of Adani company. You will sell it to me. So when between two investors it will happen, it is secondary market. Even after discussing it so much, some of you are making a mistake. I do not understand what is the problem in this. You tell me what is the problem. If you say, sir, you have told it like this, I will correct it. RBI to individual is primary market. My dear, RBI, please understand, can RBI print government bonds? Those who are saying, can RBI, when RBI will sell it to individual, can RBI print government bonds? That is my question. Can RBI print government bonds? No, government will print the government bonds, give it to RBI. So when RBI will sell government securities, don't you think that's the secondary market? Yes or no? When RBI will sell government securities, is it a primary market or secondary market? It is a secondary market. Now, if you ask me, sir, where did RBI get government bond? Imagine last week RBI purchased a bond from you. And next week, RBI will sell the same bond to me. So RBI is an investor. RBI is not printing government bonds. RBI is holding government bonds. They have invested and they will sell it to me. Secondary market. So please do not complicate it issue. Please do not complicate this issue. Keep it very simple. Who is issuing? Who is purchasing? Who is selling? If it is already present in the market, that will be secondary market. If it is introduced in the market for the first time, that will become primary market. Okay, now the types of shares. Let's start now. This is where we are supposed to start now. Let's start. The types of shares. Now, earlier, if you remember, we had a discussion regarding cooperative banking structure. Correct? Please do let me know. If I have not covered it, let me know. And I'll tell you where we have discussed. We discussed cooperative banking when we discussed a chapter of banking. Now, I said when we discussed cooperative banking, there was one point regarding cooperative banking. Through Banking Regulation Act of 2020, amendment in 2020, I had said cooperative banks now are allowed to issue, right, the shares in the market, such as the preference shares as well as the equity shares. The preference shares as well as equity shares and raise capital from the market. Now, understand what you mean by share, what do you mean by preference share, what do you mean by equity share. Let's try and understand all of them. Follow the discussion very carefully. Point number one, share. What do you mean by share? Share represents units of ownership in a company. This is the definition. Please by heart it. What is meaning of the share? Share represents units of ownership in a company. Sir, what do you mean by this? Imagine there is a company ABC. Imagine there's a company ABC. And this company has issued totally 5 lakh shares. Can I say 5 lakh shares will represent unit of ownership in this company? Please do let me know. The 5 lakh shares which are issued by the company, can I say these will represent ownership of a company? That is, imagine you will purchase 50 shares out of it. So you have 50 units of ownership in a company. If you purchase 100 shares, you will have 100 units of ownership in a company. But we generally don't talk in terms of number of shares. We'll talk it in terms of percentage ownership. We will talk it in terms of percentage ownership. Meaning what? Imagine the company has issued 5 lakh shares. If you purchase all the 5 lakh shares, who is the 100% owner of the company? Let me know now. The company, let's say, has issued 5 lakh shares. If you purchase all the 5 lakh shares, can I say you are 100% owner of the company? Anybody has a problem with this statement? You are 100% owner of the company. Now, this percentage ownership is called as equity. The percentage ownership is generally referred to as a stake or equity. Very often you'll come across these terms: stake in a company or equity ownership in a company. For example, I'll take the same number. Imagine company has issued 5 lakh shares. Out of this, you will purchase 20,000 shares. So 20,000 out of 5 lakh. 20,000 out of 5 lakh. 4 zeros cancelled. 4 zeros cancelled into 100. 51s are 52s are. How much is your ownership now? Calculation I have done. You don't worry. I have done the calculation. How much is the ownership now? Your ownership in the company will be how much? 4% ownership in a company. Now, this 4%, I will refer to this as equity ownership in the company. Any difficulty, please do let me know. I will represent this 4% ownership by saying that I have equity ownership of 4%. Or else I will also say I am owner of 4% of the company. Or else I can also say I have a stake of 4% in the company ABC. This is the basic idea of a share as well as equity. Any problem? Can we go forward now? The shares, generally there are two types of shares. One is called as a equity share. Second one is called as a preference share. One is a equity and the second one is a preference share. Now, what is the basic difference between equity and preference share? Let me explain this. Imagine a company has issued 100 shares. If you purchase a 10 shares out of this, can I simply say you are 10% owner of the company? Point number one. Can I say you are 10% owner of the company? That's straightforward. But what if these 10 shares are preference shares and what if these are equity shares? What if these are preference or what if these are equity? Two types of shares. Point number one, let me start with equity. Equity shares, right? Understand this. In case of equity shares, the returns that is provided, the dividend that is provided, the returns that is provided or the dividend that is provided, it is not fixed. The dividend that is provided or returns that is provided, it is not fixed. In 1 year, you can get a dividend of 5 rupees. In next year, you can get a dividend of 7 rupees. In third year, you can get a dividend of 10 rupees. You may get, there is no guarantee regarding the dividend in case of equity shares. Whereas in the context of preference shares, the amount of a dividend that is provided, it is always fixed. I'll repeat it. In the context of preference shares, the returns that is provided, the dividend that is provided, it is always fixed. Meaning, if you get a dividend of 4 rupee, right, in 1 year, every year you will keep on getting the same amount of dividend, that is 4 rupee, that will be fixed. Point number two, if you're equity holder, there is a risk that there could be, right, a higher dividend that you can earn or lower dividend that you can earn. Because of this, there is a provision which says equity holders will have voting rights. Equity holders will have voting power or voting rights. Now, many of you will ask me, sir, what do you mean by voting power here? Now, let's say you are 10% owner of the company. Simple question to all of you. Whenever bigger decisions of the company should be taken, should you be consulted or not? Think of it. Please think of it and answer. Imagine you are 10% owner of the company or 3% owner of the company or 1% owner of the company. Don't you think if the company wants to acquire one more company, they should ask you? If the company wants to pay 25 crore rupee as a salary to CEO, they should ask you. If the company wants to diversify its operation, open more manufacturing facilities, they should be seeking your opinion. That is basically the concept of voting right. That is in simple terms the concept of voting right. So when you are a shareholder, that is specifically equity shareholder, there will be voting right given to you. You will have a right to vote whenever decisions are taken by the company. Whereas in case of preference shares, fixed amount of dividend is given annually. Annually, fixed amount of dividend is given to you. And as a result of this safety feature that you will carry, it's a safety feature. As a result of this safety feature that is given to you, right, these kinds of instruments will not carry any kind of voting right. These instruments will not give you any kind of voting right. So preference shares, fixed dividend, no voting right. Equity shares, right, variable dividend from 1 year to next year, but voting rights are provided. I've written a term here. Preference shares are kind of hybrid instruments. Have a look at this. Preference shares, I've written a statement here, are hybrid instruments. Now, what do you mean by hybrid instruments? Let me explain. In case of preference shares, please tell me, think of this. Dividend is fixed, correct? Dividend is fixed. Dividend is fixed. And second, right, because these are shares, you are owner of a company. Any problem with this? Right, preference shares, in case of this, dividend is fixed. You will get a dividend. And right, because you are a shareholder, you will have certain ownership in the company. Now look at the concept of a bond. I hope you have revised. Look at the concept of a bond. Please tell me, in concept of bond, will you get ownership in a company if you purchase a bond of a company? Let me see. Will you get any kind of ownership in a company when you purchase bonds of the companies? No. If you are still confused, last week we have discussed the idea of a bond. Please revise. Last week we have discussed this. You are not given any ownership. You have basically given a loan to a company. Company will repay it along with interest. But on the other side, can I say fixed returns are given to you? Let me know. On the other side, can I say fixed returns, coupon rate? Right? Imagine you have purchased a bond of 100 rupee. Coupon rate is 6%. Annually, the company will give you 6 rupee returns. So please look at the preference shares features and also the features of the bonds. Don't you think it is a mix and match of equity share as well as a bond that you get preference shares? Let me know now. Don't you think you are taking certain features of equity share, certain features of a bond, and you are having preference shares? Correct or wrong? Observe and do let me know. Please do let me know. Make an observation and please do let me know. Anybody is confused with this? Can we go forward? And because you are taking, right, the instruments, features of two types of instruments, can I call this a new instrument as a hybrid instrument? Let me know. Can I call this a new instrument as a hybrid instrument? Hybrid means what? Mix and match. You are taking a mixture of two instruments here. So that is the reason preference shares are referred to as, right, the hybrid instruments. Can we go forward now? Let me know. Can we go forward? These are the two concepts of equity shares as well as preference shares. Any problem, please do let me know. Otherwise, I'll go forward. The concept of primary and secondary market, we have already covered. Points are there in the slide. I'll just revise them for you people. The company will issue the shares to the public for the first time. This is called as going public. And right before this, the company was owned privately. Private owners were there, very few people. Now company will go public means what? Shares is issued to the public. Once the shares are issued, we'll call this process as a initial public offering. And after IPO is done, the company will issue the shares again in the future. We will call this as follow-on public offering. Did we discuss IPO and FPO last week? Let me know. Did we discuss IPO and FPO last week? I'm pretty sure we have discussed it. I'm pretty sure, right? Without that, I will not say, right? Please do let me know. IPO means for the first time, company will issue shares. FPO means after IPO, anytime they issue shares, that will be called as a follow-on public offering. Once IPO is done, the shares of these companies will be available for trading purposes in the stock market. Right? And now we say the company is actually listed company. Then the concept of secondary market. The concept of secondary market. Now, what is this idea of a secondary market? The instruments which are already issued in the primary market now will be traded, will be bought, will be sold, right, in the secondary market. The shares which have been issued, again I've used the term shares, you can simply say instruments, because primary and secondary, it is applicable to all the instruments in the market. Okay, so the shares or the instruments which have been issued in the primary market now will be purchased, sold in the secondary market. Best example for the secondary markets in India are Bombay Stock Exchange as well as National Stock Exchange, BSE, as well as NSE. So these are certain points regarding primary, secondary, IPO, FPO, right, etc. If there is any issue with what we have discussed, please do let me know so that I can address your concerns and then go forward. If there is nobody, right, who says there is a doubt, then I'll go forward to the next concept, which is nothing but external commercial borrowings. Anybody has a doubt? Repeat, IFO. What is IFO? I don't know what is IFO. I don't know what is IFO. I have not discussed what is IFO. Repo full form. Repurchasing order. Repo is repurchasing order. And this is very surprising now. Under if you open the banking chapter, have I not given you the full form of repo? Arey Baba, revise, no. You people are not revising. That's a problem. Equity shares, basically, it's a simple idea. Okay, let me explain it to you. Imagine I start a company today and this company performs very well. After, let's say, 5 years or 8 years, whatever the numbers of years, don't worry. I will, right? I want more money so that I want to expand operations of the company. Now, what I'll do, I will issue the ownership of the company in the form of shares. Very simple idea, right? Why will you invest in my company? I want money. All of you will agree with this? Point number one. The company requires money. Anybody has a problem with this? Point number two, why will you invest in the company? One way that you will invest in the company is in the form of purchasing a bond. But bond is basically right, a borrowing. Bond will not give you ownership. Another way is company will give you ownership. That ownership is in the form of shares. The ownership is in the form of shares, right? So that is the reason whenever you purchase shares of a company, right, out of the total number of shares, whatever you have purchased, it is called as equity. Percentage ownership is called as equity, or else you can use the term stake in a company. Then whenever you talk about shares, there are two types of shares. One is called as a equity share, second one is called as a preference share. In equity share, from 1 year to next year, how much dividend will be given to you, it can vary. Any problem with this? It can vary. In 1 year, you can get 10 rupee, in another year, 5 rupee, third year, 7 rupee. Dividend can vary. Whereas in case of a preference share, in preference shares, the dividend that is given to you, that will remain fixed, always fixed. Right? That's the reason I said, whenever you talk about a preference shares, we use the term preference shares are hybrid instruments. Done? Okay, can we go forward now? Next one is external commercial borrowing. External commercial borrowing. Now, what do you mean by external commercial borrowing? Very simple idea. Companies from India can go to foreign market. Foreign market. Please do not ask me what is foreign market. Certain students will ask me, sir, what do you mean by foreign market? Right? So, companies in India will go to foreign market, that is outside India, and borrow from outside India. This kind of a borrowing done by companies, right? It is basically external commercial borrowing. Any problem here? Let me know. This kind of a borrowing done by companies from India from external sources. So what do you mean by external sources? Imagine there is a company A. Company A will take loan from a bank in USA. Please tell me, can I call this as external commercial borrowing? Let me know. Very simple idea. Do not complicate it. Always keep it simple. Please do not complicate it. The company A, it's an Indian company, will go to USA, borrow, that is, take a loan from a bank in USA. Can I call this as external commercial borrowing? Answer is yes, by the way. Let me give you another example. A company in India, right? Let's say same company A will go to UK market, issue bonds in the UK market, and borrow from the UK market. Can I call this as external commercial borrowing? Any problem here? Can I call this as ECB, external commercial borrowing? Again, the answer is yes, because Indian company has taken the loan from outside India. Now, point number 2. Please do tell me, can I say now, best example that we have already discussed regarding ECB is a masala bond? Tell me, correct or not? Last week, right? If you say, sir, where have you discussed masala bond? Last week. And those who are saying, sir, this is my first class, please do not worry. When the classes will happen again from the first class, please attend them. Because you have joined in the middle, right? Do not panic. Right? I'll give a very simple analogy. Simple analogy. Imagine you have gone to a movie after 1 hour of a movie starting. Movie has already started. You enter into the cinema hall after 1 hour. Please tell me, initially, will there be a confusion or not? I hope you understand this. Will there be a confusion? Right? Hero will tell something to heroine. You'll keep on pestering your neighbor why hero is saying that. Right? Hero will hit someone. You'll ask your neighbor why is the hero hitting someone. Right? Apply the same analogy in the classroom as well. Already some of the classes are over. We have covered many concepts. Now you have entered, right, always almost at interval situation. So there will be confusion. Please do not worry. Attend the classes when they'll start from the beginning. Now, can we go forward? Let me know. Masala bond. Can I say it is the best example of external commercial borrowing that we have already discussed? Now, please tell me, because we have discussed masala bond, now third point, can I say this Indian company can borrow from the external market either in a domestic currency or foreign currency? Correct? This Indian company can borrow from right the external market, international market, right, either in domestic currency or foreign currency under ECB. Any problem with the third point? If you ask me, sir, how can they borrow in the domestic currency? My point will be, sir, have you revised? Madam, have you revised masala bonds? If you have revised masala bonds, Indian company will borrow from USA in what currency? Tell me now. Under masala bonds, please participate. Please participate. Many of you have already become dormant. Please participate. Under masala bonds, an Indian company, let's say, will go to USA, borrow in which currency? Do you think Indian company will borrow in dollars there? No, that is not masala bond. Masala bond, Indian company will borrow in rupees. Correct? Domestic currency. That is rupees. So now can I say under external commercial borrowing, Indian companies will be allowed to borrow either right in a domestic currency or in a foreign currency. That is point number 3. ECB refers to the debt taken from the external market from borrowers right within India. The borrowing either can be done by issuing bonds, by taking loans, etc. This can be in the form of a domestic currency or it can be in the form of a foreign currency. Now, who is allowed to borrow under ECB? Can you borrow under ECB? Can I borrow under ECB? Who is allowed to borrow? Please remember the statement here. All the companies in India which are working in the sector where FDI is allowed. I'll repeat the statement here. I have not covered FDI. I know that. Please don't worry. All the companies which are operating in the sector where FDI is allowed in India. What do you mean by FDI? foreign companies will bring money and invest in the sector. I'll repeat the statement. Foreign companies will bring money and invest in these sectors. These are called as FDI open sectors. Can anybody think any recent sector where government is actually attracting lot of FDI? Let me see. Let me see. Very, very simple example. This is where current affairs will help you. I've not discussed FDI, I know that. But please tell me, in recent times, when you're reading newspapers, have you seen any sector where government of India says even foreign companies can come and invest in India? Can I give you examples? Mobile manufacturing. Please tell me. Mobile manufacturing. Correct or wrong? Right. What about semiconductors? Correct or wrong? Please do tell me. And right, what about laptop manufacturing? Don't you think that government of India is basically promoting foreign investment in these sectors? If you ask me, sir, how can you say? Right, I've read these articles, but I did not understand how government is promoting foreign investments in India. My dear, please tell me yesterday's newspaper article I'll take. I've not given the article here, but yesterday's newspaper article, have you read about this article in yesterday's Hindu headline, which says imports of certain electronic products into India now will be restricted? Please tell me. Yes or no? Those who have read newspapers, that's the reason I say, please read newspapers. Please read newspapers. Government of India says, again, that has been changed now. It has been amended now. It will be postponed for certain months. Certain electronic products, around 7 to 8 electronic products, PCs, tablets, etc., laptops, etc., right? If you want to import it, you'll have to take a license from government of India, which can I not say, which will also mean that government is promoting investment within the domestic market. So I hope you understand the argument here. There are various sectors wherein foreign companies are allowed to invest. This foreign investment in India, it is called as foreign direct investment. So any company which is operating in a sector where FDI is allowed, they are also allowed to borrow under external commercial borrowing. Next, eligible borrowers under this route can borrow up to $750 million or equivalent amount per year under external commercial borrowing. But please understand, I've written $750 million here today, but RBI very recently has doubled this to $1.5 billion. Many of the books also have given 750 million, but please remember this. It is not 750 million now, it has been doubled to $1.5 billion. So under this, you can simply borrow from external market up to $1.5 billion, right, per year. Any problem with what we have discussed? Any problem with this? Right, basically the points that I've discussed. Don't worry about yesterday's article. I'll discuss that. Have patience, my dear. Have patience. Don't worry about yesterday's article. When I take up WTO, you will understand why government of India uses security logic or breach of data logic whenever they impose those kind of restriction. I'll teach about it. Don't worry. But come back. Tell me about ECB. Point number 3. All these companies which are eligible to attract foreign investment, now these right can borrow under ECB. It's very simple. All companies which can attract foreign investment in the form of FDI are eligible to borrow under ECB. Okay, right? Now, what are the advantages? Why do we promote idea of ECB? What are the advantages? First one, it will allow more access to money for Indian companies. Is it advantage or not? Please do let me know. If you're a company, don't you think you should have more options to borrow from the market? You should have more options to raise capital from the market. That is the advantage here. Second one, the rate of interest, what if in the international market is lower compared to that of India? Imagine you will take a loan from India, you issue a bond in India, rate of interest is around 6%. But in a foreign country, let's say you can borrow, but rate of interest is only 3%. Please tell me, right? Please tell me, don't you think that becomes an advantage for you? For a borrower, don't you think that's an advantage? Answer is yes, by the way. That is an advantage. Third one, it will also help the Indian companies to import machinery without having to convert rupee to dollar. Don't you think this is an advantage here? Please follow the discussion. Please follow the discussion. Right? It will help Indian companies to import machinery without having to convert rupee to dollar. That is the advantage here. Right? Some of you ask, sir, why? Why this is an advantage? Imagine last year, 50 rupee was equivalent to $1. And this year, $1 is equal to 60 rupees. Now, don't you think rather than converting rupee to dollar, if you can get the money in terms of dollar, use the dollar to purchase a machinery, that will work in your favor? Any problem with this point? That will work in your favor. Right? That is the other advantage. That will work in your favor. That is the advantage. Okay. So these are some of the advantages regarding ECBs. Having said so, what are the concerns? What are the problems or disadvantages? Point number one, volatility in the exchange rate is always a concern regarding this. Right? That is, let's say last year it was $1 is equal to 50 rupees. And today it is $1 is equal to 60. So you have looked at it and said, sir, I don't want to convert rupee to dollar. I will borrow dollars in the external market. I will use the dollar to pay for the machinery. But tell me the next point, will you have to repay this dollar after 2 years or 3 years or not? Let's say after 4 years, you're supposed to repay this dollar because it is a borrowing. Now, what if I say after 4 years, $1 was equal to 80 rupees? Let me know. After 4 years, what if I say $1 was equivalent to, right, 80 rupees? This is a concern for you or not? Yes or no? Anybody has a problem? This is a concern for you when you're paying this particular dollar. Correct or wrong? It is correct. Because now you will have to convert your rupee to dollar because you will have to repay the dollar. So volatility in the exchange rate, it is always a concern regarding external commercial borrowing. The credit is available at a cheaper rate of interest, and this might force the companies become complacent. The companies might become much more relaxed. The companies might take it granted, do not use the money efficiently because the money is available at a lower rate of interest. That is the second concern. Third, it will increase the dependency of Indian companies on a foreign market. Think of it. More and more borrowing means Indian companies become more and more dependent on the foreign money, foreign market. Where is your Atmanirbharta, self-reliance? Right? Don't you think reliability more means, right, that is a negative feature? And finally, whenever you keep on borrowing from the market, either from the foreign market or domestic market, doesn't matter. Whenever you keep on borrowing from the foreign market, there is always a pressure of repayment. There is always a huge pressure of repayment. And the market, that is your investors, right, the stakeholders in the economy, generally they will look at a company when they borrow more money, there is a concern regarding repayment associated with that company. The market will view this kind of a borrowing negatively. Why? Because you are borrowing. If you keep on borrowing, there is in future payment pressure in the future. Right? That is the reason when high amount of borrowing is done, market will consider this as a negative feature associated with the company. Done? So these are certain points regarding the concept of external commercial borrowing. Anybody has got any kind of an issue, please do let me know right now. Anybody has got any kind of an issue regarding ECB? Can we go forward? Equivalent per year under ECB means, imagine, I'll give a very simple example. Imagine the limit was $1. I've given $1.5, $1.5 billion, forget it. Imagine the limit under ECB was $1. So, can I borrow in the external market directly in the form of dollar? Of course, yes. And what if I borrow in terms of rupees? Can I convert that borrowing? Can I convert that, count it in the form of dollar? Of course, yes. That is, let's say, today $1 is equal to 50 rupees. Please tell me if that was the limit. If I borrow 50 rupees from USA, can I say I've reached ECB limit? Let me know. Those who are asking this kind of a question, please do let me know. If I borrow 50 rupees from USA issuing a masala bond, can I say I've reached ECB limit or not? External commercial borrowing limit, assuming it is $1 as of now. Participate. Those who are asking questions, at least those who have asked questions, participate. Only then I can understand, okay, the person has understood. Otherwise, I'll simply go forward. If you don't participate, I'll simply go forward. Okay. Last point. If you borrow more and more, imagine you're running a company. If you keep on borrowing more and more, should it be considered a positive for the company or negative for the company? You think of it and tell me. If a company will keep on borrowing more and more money, do you think that is positive for a company? And that is important. Why? You're not borrowing some amount, you're continuously borrowing more amount, which means if you borrow today, you're supposed to repay after 5 years. Don't you think there's a payment pressure on the company? Think of it. Right? After 7 years, don't you think there's a payment pressure on the company? And annually you'll have to pay interest also. So that is the reason under ECB, if companies will keep on borrowing more money, market will look at this as a negative feature, right? Because they will borrow from external market, they will borrow from domestic market as well. Okay, done. Let me go forward now. Let me go forward. Concept of P notes. These are also called as participatory notes. P notes or participatory notes. Now, what do you mean by participatory note? Let me explain with an example. Understand the example. Please understand the example first. Let's say there is a foreign institutional investor already present in India. Now, what is a foreign institutional investor? I'll give a very simple example here. Please follow this. Imagine this is India. And let's say from USA, right, there is an individual who wants to invest in India. There is an individual who wants to invest in the Indian stock market. There is also an insurance company which wants to invest in Indian market. There is also a mutual fund company which wants to invest in the Indian market. Point number one, please follow this. Point number one, if I take all the three, 1, 2, and 3, if I take all the three, can I simply call this as total foreign investment in India stock market? Please do let me know. If I take all the three, right, 1, 2 as well as 3, can I say total investment done by foreign investors in Indian stock market? Now, please understand, there is a term called as foreign portfolio investors. Some of you are saying no. Why are you saying no? Please do let me know. Why are you saying no? Please do let me know. And don't say, sir, what about USA? What about UK? I'm not discussing all of it. Assume this is India. Assume this is USA. 3 investors are coming from USA. Now, there's a term called as foreign portfolio investors. We'll discuss this today. Next week, when I take up FPI, please do not be confused. Okay, foreign portfolio investors. Now, please tell me, can I say all the 3 are nothing but foreign portfolio investors? Let me know. Can I say all the 3 are nothing but foreign portfolio investors? Portfolio means collection. Very often you will come across the term portfolio. Portfolio means group. Portfolio means collection. So can I say all the 3 of them are foreign portfolio investors? Now let me ask you a second question. Can I say all the 3 of them are institutional investors? Now this is tricky. Think of it. Please think of it. Can I say all the 3 of them are institutional investors? Institution. That is very tricky. Please remember this. Institutional investor. Institution means what? A bank, right? A mutual fund company, a insurance company, a hedge fund company, etc. Institutional investor. Can I say one is not an institutional investor? Yes or no? Can I say one is not an institutional investor, whereas a 2 and 3 are institutional investors? This is important. Please remember this. Let me know. This is important. Please remember this. Foreign portfolio investors or foreign portfolio investment simply means what? Any investment that is coming from outside India into India in stock market, bond market, etc. I'll repeat the definition. Follow this very carefully. Foreign portfolio investment means any investment which is coming from outside India into stock market, bond market, etc. Whereas foreign portfolio investment, within foreign portfolio investment, we will have foreign institutional investors. Can I go forward? Within foreign portfolio investors, basically you will have foreign institutional investors. Can we go forward? Any problem with this? What if they have different purposes? What is the problem? Let them have any purpose they want. What is the problem here? What is the purpose? The purpose is investing and getting money. Any problem in having a different purpose? No problem. What is the issue? How individual is a portfolio? Portfolio means collection, my dear. Portfolio simply means collection of investments. You as an individual, think of it. Let me check current affairs. Let me see how many of you are actually reading current affairs. You are an individual. Can you invest in a portfolio? Let me see. You are an individual investor. Can you invest in a portfolio? Please do let me know. Or some of us saying no. Portfolio means what? Let me know. What do you mean by portfolio? First and foremost, you are able to understand the term or not. Portfolio means collection of securities, group of securities. Can you purchase a share of Adani company? Can you purchase the shares of Tata company, Infosys, government securities, and Paytm shares? Now, can I say, if you have invested in all of this, this is your portfolio? Let me know. If you have invested in all these instruments and you have purchased all these instruments, can I call this as your portfolio? Arey Baba, please participate. Let me know. Can I say if you have invested in all these shares, bonds, etc. and purchased, can I call this as your portfolio or not? Can I call you as a portfolio investor? Portfolio means collection. That's it. Do not complicate it. Portfolio means group of instruments, not one group of instruments. Okay. So come back to the point now. Please come back to the point. Point number one. Whenever foreign institutional investors want to invest in India, they will have to be registered with SEBI. Point number one. Whenever foreign institutional investors want to invest in India, they will have to be registered with SEBI. SEBI is the market regulator, hence why. Now imagine there is a foreign investor, any investor. It could be a company, it could be an institution, it could be an individual. Don't worry. There is a foreign investor X. They want to invest in the Indian stock market, but they do not want to go through the SEBI route. They do not want to go through SEBI route. What do you mean by SEBI route? They will have to approach SEBI, submit documents, wait for certain time. SEBI will give you clearances or approvals. After this, you are allowed to invest in the stock market. This, as per many experts, might take 2 months, might take 3 months. Many of the times, SEBI will ask for additional proof, additional documents, etc. Now, what if you are the investor and you do not want to wait for 2 months? Simple question. What if you are the investor who do not want to wait for 2 months here? Is there any other opportunity available for you wherein you can invest in India but without going through the SEBI route? There is one opportunity which is called as participatory notes, which is basically referred to as a participatory note. Now, what will happen in participatory note? Imagine there is a foreign institutional investor, who has invested in the Indian stock market. They will issue participatory note to you. They will issue a participatory note worth, let's say, 1,000 rupees. And I'm using rupees. Generally, these are denominated in foreign currency. Don't worry. They will issue a participatory note worth 1,000 rupee to you. They will collect 1,000 rupee from you. Now, on your behalf, they will invest this 1,000 rupee in India's stock market. Any problem with the cycle here? Please do let me know. Step 1 is very simple. The foreign institutional investor will issue the P note to you, you can purchase the P note, pay the money to the institutional investor. They will collect the investment. Now they will use the investment to invest in India's stock market. Now, follow this and please let me know the answer. Did you invest in India's stock market through the investor? Question number 1. Did your investment enter into India's stock market through the investor, that is an institutional investor? Yes or no? Please participate and do let me know. Only then I can understand you that you are understanding. No, sir, I invested direct. Are Baba, did you follow the process or not? Did you follow the process of P note? You will give 1,000 rupee to this company, institution. You will purchase a P note. Now they will take this 1,000 rupee, invest in India stock market. So my question in this example, did you invest your money in India's stock market through the institution? Some of you are saying no. How? Are Baba, what I'm asking, answer to that. Don't do anything else. Right? Don't try to create situations or don't do anything else. Answer to my question. In this example, did you invest through institution or not? Now I'll tell you one point. Some of you always try to do something else. If I see that you continue to do that, one, I'll stop asking question. I'll assume you've understood. I'll keep on going forward. Please, let's not do that. I want you to understand. That is important. I want you to understand the concept. Okay. Second point. Think of this. Did you register with SEBI in this example? Second question. In this example, did you register with SEBI? Some of you are saying yes. Where? Those who said yes, tell me, where did I say you registered with SEBI? Please tell me where. Did I say that? When you purchase P note, do you require to be registered with SEBI? You do not have to be required. There is no requirement to register with SEBI. Please listen to the class very carefully, my dear. I don't know what you're doing. There are two students. I do not want to take the names, but please listen to the class very carefully. If you're not able to listen for 5 minutes, 10 minutes continuously, then what is the point? How will you become IS officers in the future? Think of it. So point number 1, you're not registered. Point number 2, right? X has already invested in Indian stock market through a foreign institutional investor. Point number 3, can I say P notes are issued outside India? Point number 3, right? Can I say P notes are issued outside India to the foreign investors? Anybody has a problem with these points? These are the points that I've written here. Participatory notes are also referred to as P notes or PNs. Point number 2, these are financial instruments used by the foreign investors so that they can invest in India's market. Any problem? These are the instruments which are used by the foreign investors so that they can invest in Indian market. Point number 3, the foreign investors do not have to register with regulator of India, that is Securities Exchange Board of India. And point number 4, P notes are amongst the group of investments which are considered to be offshore derivative investments. Now, what do you mean by offshore derivative instruments or investments? Let me explain it to you. Point number 1, offshore. What do you mean by offshore? Can I say offshore means outside India for us? Let me know. Can I say offshore is nothing but outside India for us? Now, did we not already conclude that P notes are issued outside India? So, can I call these instruments as offshore instruments? Let me know. Can I call these instruments as offshore instruments? And point number 2, there is a term called as a derivative. There's a term called as a derivative. Now, do not enter into the concept of derivative market. Derivative market is very complicated. For GS paper, not required. I'm pretty sure, look at some of the questions asked by students, some of you are involved in trading. I can know that. But do not enter into derivative market. Let me explain in a very simplified way what do you mean by derivative instrument. What do you mean by derivative instrument? Let me explain it. Let me define. Point number one, let me define. Derivative instruments are those instruments which will derive the value from underlying asset. Listen first. Please listen. Derivative instruments are those instruments which will derive their value from underlying asset. Sir, what do you mean by underlying asset? Let me explain it to you. Imagine you will give me a certain amount of money. And I will issue one instrument to you. I will give you one instrument and I'll say the value of this instrument, I repeat, the value of this instrument is connected to price of tomato. Although in agriculture commodities, mainly it is rice and wheat. Let's take a very simple example. The price of this instrument, I will say, it is connected to the value of tomato. Now, can I simply say that because I've connected value of the instrument to the value price of the tomato, if the price of the tomato goes up, what will happen to value of this instrument? Let me know. If the price of the tomato goes up, what will happen to this instrument? The value of the instrument will also go up. The price of the tomato goes down, what will happen to market price, or let's say the value of this instrument? Price of the instrument will also go down. Can I now say, look at the definition, can I now say, in this, the instrument is deriving the value from underlying asset. Correct or not? Please do let me know. In this example, the instrument is deriving its value from an underlying asset. These are called as derivatives. There's a very large market. There's a very large market within the financial market, which is called as very famously derivative market. There is option, right? There is derivatives such as options, contracts, etc., etc. Do not worry, but tell me, is the concept of derivative, why do we refer to the instrument as a derivative? Is it okay with all of you? Let me know. Why do we call this as a derivative? Is it okay with all of you? Now, in this example, think of it. Imagine I'm the foreign investor. You are the institution. I will give you 1,000 rupee. You will use the 1,000 rupee to purchase, let's say, share of Adani company. Very simple idea. You will use the 1,000 rupee to purchase the share of Adani company. Now, if the shares of Adani company will start increasing, what will happen to my investment? What will happen to the value of participatory note? Participatory note value will start increasing. Yes or no? Because you have taken this 1,000 rupee, and right, this 1,000 rupees worth of nothing. This is equivalent to P note. So you have taken the 1,000 rupee. I have a P note. You purchase the shares of Adani company. If the market price of Adani company share will go up, what will happen to value of P note? Value of P note will go up. And if shares of Adani company will fall down, what will happen to value of my P note? Value of P note will start falling down. Now tell me, can I say P notes or offshore derivative instruments? Can I go forward now? Can I say now, right, derivatives are nothing but, P notes are nothing but offshore derivative instrument. That is basically the definition, the discussion regarding participatory notes. Participatory notes. Can we go forward? Is a derivative same as indexed? Not necessarily. In case of indexation, we generally connect one instrument. A derivative. Within derivative, there are a lot of instruments. Within the derivative. Right? I'm pretty sure some of you have used Google by now. Typed in the Google derivatives. You will come across 4 types of derivatives in the derivative market. My recommendation, Do not do a PhD on that. Do not worry about that for UPSC exams. There's options, there is a contracts, there is a forwards, etc. For UPSC, you do not require so much of it. Okay, can we go forward now? Can we go forward? Come to credit rating, right? Connect it to current affairs. Please connect it to current affairs. Whatever you're reading, connect it to current affairs. That is how you understand current affairs, and remember static information as well. Now, point number one, what do you mean by credit rating? What is the definition of credit rating? I've given the definition here. Please have a look at it. Credit rating refers to the ability or willingness of a borrower, who can be a company or a government, etc., to repay the debt. Very simple definition. Very simple definition. Credit rating refers to what? It refers to the ability or the willingness of the borrower to repay the debt in the market. For example, can I say Government of India borrows from the market by issuing government securities? Government of USA issues the securities in the market and borrows from the market. So what is the willingness of the borrower? What is the ability of the borrower to repay the debt? That is called as a credit rating. Now, generally, the credit rating is a combination of alphabets and numbers, or it is simply alphabets. I'll repeat it. Either the credit rating is given as a combination of alphabets plus numbers, or else it is simply alphabets. For example, the most important rating agencies, have you come across one of them recently in the last 2 days in the newspaper? Do let me know. The most important three international rating agencies. The three important rating agencies in the global market. One is S&P, second one is Moody's, third one is the Fitch. Right? So I'm pretty sure if you've read the newspaper, you would have come across the term Fitch in the newspaper. The term Fitch, company Fitch in the newspaper. Now, what is the basic idea? All the three are American companies. All the three are USA rating agencies. But why these are important? Around 90% of global rating market is occupied by only three agencies. I'll repeat the statement. Why these three are very important? Why so much is being discussed about a Fitch rating for USA? These three are USA companies. Around 90% of the global rating business is controlled by these three companies only. And that is the reason when these three companies will make changes for credit rating, that becomes a very, very important point. Now we'll connect it to current affairs. Don't worry. Please observe the table here. Please observe the table. Please do not by heart everything. I'll tell you certain tricks. Please observe the table. Now, let me enter into table. The three agencies are Standard and Poor, Moody's, and Fitch. And if you remember, I told you rating agencies, right, are ratings which are provided by these agencies either are simply alphabets or a combination of alphabet plus number. If you look at Standard and Poor and Fitch, you will see that these agencies simply use only alphabets to provide credit rating. Whereas Moody's will take a combination of alphabets as well as numbers. Point number one. Point number two, these rating agencies generally use these grades to provide what is a credit rating either for a company or for the government. And when they provide it for government, this is called as sovereign credit rating. Any difficulty, please do let me know. I'm talking about second point now. Whenever they provide it for a government, when they provide the rating for government means what? Government borrowing through bonds. When they provide it for the bonds or the instrument used by the government, this is called as sovereign credit rating. So did you not come across in the newspaper which says sovereign credit rating for USA? Sovereign credit rating for USA has been reduced from AAA to AA. Correct or wrong? Please correct me if I'm wrong. Please do correct me. The newspaper articles, if you have read, they will simply say sovereign credit rating for USA has been reduced from a triple A to double A. Again, they will use plus, minus, etc. I will tell you positive outlook, negative outlook. What is the meaning of it? Have patience. I will tell you. Don't worry. But don't you think it is a double A? Rating is in the range of double A. From triple A, now it has been downgraded to double A. Now think of this. Just make an observation here. If your rating will be reduced like this, if your rating will be reduced, can I say risk associated with this instrument has increased? I'll repeat the statement. If your rating is reduced from triple A, now the rating will be reduced to double A. Can I say risk of investing in these instruments has increased? Now tell me, if the rating is further reduced to triple B, right? Don't you think the risk associated with instrument has further increased? From triple B, it will be reduced to D. Then it basically means the highest risky instrument. It is the highest risky instrument. So remember the logic here. As you keep on moving downwards in the table, risk will start increasing. I'll repeat the point here. As you keep on moving downwards in the table from triple A to double A to C, C to D, whatever rates, if you keep on decreasing the rating like this, the risk will start increasing. Point number two, if the risk will start increasing, what should happen to the interest rate on such instruments? Let me know. Point number two, if the risk is increasing, what should happen to the coupon rate, yield rate, or interest rate on such instruments? What should happen to the coupon rate or yield rate? Don't you think the coupon rate or yield rate should start increasing? Some of you are thinking exactly opposite. Think of it. Think of it. Make rational decisions always. Imagine I'm offering an instrument, and right, you will basically say, okay, I want returns of 6%. And this has a coupon rate, I'm sorry, if this has a credit rating of double A. And I'll give you one more instrument which will have a credit rating of C. Will you demand 6% coupon rate on this? Should you demand 6%? Absolutely no. You should not demand it. Why? Are you not taking a higher risk by investing in an instrument with a C rating? Of course, yes. So should you demand 6%? No, you should demand 8. You should demand 9. You should demand 10. You should demand 11. Nothing wrong with that. Why? Risk component is very, very high. So when the risk will increase, automatically the coupon rate will also start increasing. Now please check, right? If you have not read it, please check what has happened to yield rate on government of USA securities in the last 2 days. I hope you understand. Please check. This is the beauty of economics. This is how you connect to current affairs. Please check what has happened to the yield rate on government securities in the last 2 to 3 days. You will realize that the yield rate on government securities issued by USA has actually increased. If you don't trust me, please check it. Please check it. Nothing wrong with that. Please check it. By how much is not important. It could have increased by only 0.03% or 0.05%. Nothing wrong with that. But do you understand now, if I say, if credit rating for government of USA's bonds have been reduced, yield rates have increased. Does it make perfect economic sense or not? Let me know. Does it make perfect economic sense to you people or not? Right? It should make perfect economic sense. Okay. Now, credit rating is provided by credit rating agencies. The credit rating generally provides information about the past and does not guarantee the future performance or payments. Remember this, very important. Credit rating will give you information regarding how the borrower has behaved in the past, but it doesn't guarantee. It doesn't guarantee what is going to happen in the future. For example, one of the reasons which has been cited by the Fitch rating agency to downgrade USA's rating from AAA to AA is that the debt of government of USA has increased. Correct? Those who have read the newspaper, please do let me know. The debt of government of USA has increased in the last couple of years. And when the debt has increased, right, automatically the repayment pressure on the government of USA will also increase. And as a result of this, there is a risk associated. Hence, we have downgraded from AAA to AA. But please tell me, this downgrading, is it a guarantee that USA will not repay after 2 years? Let me know. Is it a guarantee what is going to happen to the USA government after 5 years? Right? Does it guarantee that you will not get the money if you invest in government of USA after 10 years? Absolutely no. It is basically a performance measure of the past and what can happen in the future, but it is not a guarantee. It is never a guarantee. I'll give you examples also. There was one company by the name of IL and FS in India. Very, very infamous now. There was one NBFC, one of the largest NBFCs in India, IL and FS, infrastructure leasing and financial services. The bonds which were issued by IL and FS carried a AAA rating. Understand the point here? The bonds which were issued by IL and FS carried a AAA rating. AAA rating. Let me know. AAA rating means what? Highest credit rating. Highest credit rating. One fine day, IL and FS defaulted on the payment of their bonds. And the reason was very simple. They invested, wrong decisions were taken in the by the management. They invested in wrong assets. They were not able to generate revenue, incurred losses. They defaulted on the payment of AAA bonds. So don't you think whatever is a credit rating, it is an indicator, but it does not guarantee the future performance of the instrument. Can we go forward now? Let me know. Can we go forward? Next important point. Whenever the instruments are issued and are given credit rating like this, generally we will divide them into two parts. Generally, we will divide them into two parts. One, I've grouped it with a red marker. Another, I'll change the marker, right, into, let's say, blue. Another group is this group. So credit ratings can be divided into two groups. One is called as a investment grade and the second one is called as a junk grade. One is called as a investment grade and the second one is called as a junk grade. Now please tell me, can I say any bond, any instrument which has a credit of less than triple B or less than Baa3 is basically a junk grade bond? I'll repeat the statement. Any bond which has a credit rating of less than triple B or Baa3, right, basically means that it is a junk grade. It is a junk credit rating. And if any instrument is there with a junk credit rating, don't you think the coupon rate on that will be much higher compared to a bond with investment grade rating? Can we go forward now? Why I'm discussing all of this? Please look at the credit rating for India. Sovereign credit rating for India. US's credit rating is a AA now. What about India? India's sovereign credit rating is a triple B, and Baa3. Triple B, and Baa3. Now, many of you will ask me, sir, what is this plus minus given here? Generally, there is a concept called as outlook. Outlook, right? Outlook is given in the form of stable, positive, negative, etc. Positive, negative, stable, etc. What do they mean? Right? They basically are indicating what can happen to the rating in the future. Simple, right? If they say stable, it simply means the credit rating might not change in the coming days. Right? If they say doubtful, negative, positive, it simply means that the credit rating might change in the coming days. Do not worry about outlook here. Focus on the credit rating, sovereign credit rating for India. Triple B, Baa3. Can I say India's sovereign credit rating is lowest grade for all the three credit rating agencies? Let me know. India's sovereign credit rating, right? It is the lowest grade within investment category. Are Baba, those who are saying yes, no, please make observations. Please make observations. Baa3, triple B. Can I say this is the lowest grade within investment category? Now, if there is one more downgrade, imagine if there is just one more downgrade for India's category or India's sovereign credit rating, we will fall into junk grade. Correct? Will fall into junk grade. And falling into junk grade means what? Investing in government securities becomes a very risky. Please tell me what will happen to cost of borrowing for government of India. Let me know. What will happen to the cost of borrowing for government of India? Do you think government will be able to borrow at a lower rate of interest or higher rate of interest? Can I say cost of borrowing for government will start increasing? What will happen to fiscal deficit? What will happen to fiscal deficit? Fiscal deficit will start increasing. All of you okay with all of this? Fiscal deficit, right? For the deficit for the government of India will start increasing. Third point, do you think with this kind of a downgrade, right? Any kind of downgrade from triple A to double A or triple B to double B, right? BAA3 to let's say BA1, any kind of a downgrade, please let me know if this kind of a downgrade happens for an economy. Do you think Indian companies will be able to borrow at a lower rate of interest from external market? Indian companies, mind you. Do you think if India's sovereign credit rating is downgraded, do you think Indian companies will be able to borrow at a lower rate of interest from the foreign market? Right? No. Foreign investors will be much more concerned because sovereign means government. Government credit rating is going down means there is problem with the finances of the government. If government finances are becoming a problem, don't you think the whole economy might face difficulties now? So Indian companies, if they want to borrow from USA under ECB, now they'll be asked to pay higher rate of interest. They'll be asked to pay higher rate of interest now. Why? The whole economy is risky for them. That is the point. So please remember these kind of points. Can we apply the same logic to government of USA with this kind of a downgrade? Let me know. Can we apply the same logic to USA now with this kind of a downgrade? That is, interest burden for USA will start increasing. The deficit for government of USA will start increasing. The companies in USA, the US companies, if they want to borrow from external market, and now they'll be asked to pay higher rate of interest, etc. These are certain implications of sovereign credit rating. Now, next important point, let me connect it to current affairs. Let me connect it to current affairs. If US's sovereign credit rating is downgraded, why did it affect India's stock market? Has anybody thought of it? Let me know. If there is a downgrade for USA government from triple A to double A, why is India's stock market taking a hit? Right? If you have read that article the day for yesterday as well as yesterday, India's stock market fell down, both NSE as well as BSE. Both NSE as well as BSE took a hit in India by 1%. More than 3 lakh crore rupee worth of investment was actually wiped out in India because of this announcement. Question is why? If something is happening in USA, why should it affect India? Why should have an impact on Indian stock market? Point number one, this will always happen under the concept of spillover effect. Correct or not? I'll tell you exactly why it has happened, but don't worry. Can I say this is always an impact of spillover effect? If something happens in USA, something happens in UK, which is not good for India, that will be exhibited in Indian market. Point number two, let me explain why this has actually happened. Remember this very carefully. Foreign investors have withdrawn their money from India, have taken their money from India and invested in the USA. Very simple. They've withdrawn their money from India and they've invested in USA. And this generally happens. I'll tell you why. If you're a USA investor, please do let me know. In case of uncertainty, would you want to invest in terms of rupee instruments or dollar instruments? Very simple question. If you're an investor from USA, right, you're having dollars, right, in times of uncertainty, in times of volatility, would you want to invest in rupee instruments or dollar instruments? All of you will choose dollar instruments. Some of us saying rupees. Why? Those who are saying rupees, tell me why. Because you should not do it. You are a USA investor. In times of uncertainty, volatility, you should always take your money, run back to USA, invest in your domestic currency. That is exactly what the foreign investors have done. Second point. Third point. Sir, what is the reason? Anything else? Why they are doing it? Please think of it. What has happened to, right? Answer this now. What has happened to the yield rate with this announcement of a downgrading? What has happened to yield rate on government of USA security? Tell me now. What do you think should happen to the yield rate on government securities of USA? Yield rate has increased. Correct? Yield rate has increased. Now, with the rise in the yield rate of government securities, don't you think the difference of interest rate between this government security yield rate and returns in Indian instruments will come down? Let me know. I'm using the term difference here, right? Difference, the gap, right? Difference is nothing but the gap. The gap between the returns that you get on investing in USA government bond and the returns that you get in Indian market, will the gap narrow down or not? Let me know. Will the gap narrow down or will the gap increase? The gap will narrow down. Now, please tell me, if the gap will narrow down to 0%, to 0.1%, 0.2%, what is the incentive for you to bring your money from dollars to rupees and invest in India? Think of it. What is the incentive for you? Is there any incentive, bigger incentive for you to bring your money from USA, that is dollars, in India and invest in Indian rupee? Is there any bigger incentive for you? No. Incentive will start vanishing. Incentives will simply vanish off. And if the incentives are not there or incentives are negligible, will you continue to invest in India? Think of it. Will you continue to invest in Indian market? No, it doesn't make any sense to you. You will take your money, right, move out of India, invest in the USA's bonds. Now, if you start withdrawing your investments from India, start withdrawing means what? You had shares of Adani company, you will start selling. You had shares of Paytm, you'll start selling. If you start selling the shares in the market, please tell me what will happen to market prices of the shares? If these foreign investors will start selling all these shares in the market, what do you think will happen to the market prices of the shares? Can say market price will go down. And when the market price will go down, what do you think will happen to Sensex? Sensex is the indicator for BSE. What do you think will happen to Nifty? Nifty is an indicator for NSE. Don't you think these indicators will also go down? You had invested in a share of Adani company, hypothetically. Do not take it literally. Imagine you had invested in shares of Adani company and your investment was 100 rupee. Because of this, if your investment has become 90 rupee, can I say your investment has eroded by 10 rupee? Let me know. Because of this, if the market price of Adani company will fall down from 100 rupee to 90 rupee, can I now say your investment has eroded? Eroded means vanished. Your investments have come down, eroded by 10 rupee. Correct or not? Anybody has a problem with this? Right? So your investments will start eroding. Please check the newspaper now. You will read the newspaper. Now you will understand why more than 3 trillion rupee worth of investments have vanished because of downgrade for USA sovereign credit rating. Any problem in understanding the equation here? Any problem in connecting the dots? Please do let me know. Can I go forward? Can we go forward now? Will you be able to read that article and understand why India's stock market took a hit? Let me know. Will you be able to read that article now and understand why India's stock market took a hit, declined, BSE went down, NSE went down, why investments eroded in Indian market? Right? So these are certain important points. Please go through them. UPSC can ask you all of this. Trust me, UPSC can ask you all of this. They can ask you about all of these concepts in the preliminary examination. Right now, many of you will simply say, sir, in none of the books it was covered. Can I say this is purely from current affairs? Let me know. This is purely from current affairs. As a result of sovereign credit rating downgrade that happened in USA, Indian stock market took a hit. It is from current affairs. None of the books will give you. Right? None of these books will provide discussion regarding this. Don't search for this in the books. Can we go forward? Third point. My dear, if the yield rate in USA, government security will go up, let's say from 6% to 6.5%, and you are investing in India's stock market, your returns is, let's say, 6.6%. Please tell me, when the yield rate goes up to 6.5 and your returns are 6.6, can I say you are getting additional 0.1% interest by investing in India? Point number one, those who are asking this question, answer it. Your additional returns is 0.1% by investing in India. And point number two, because of sovereign credit rating, the yield rate has increased. Now, can I say, point number two, the gap which was existing earlier between this rate and this rate has become narrow. Correct or not? The gap which was 0.6% earlier has narrowed down to 0.1%. Now, what is the incentive for you to make investments in India? Hardly 0.1% incentive. You are earning 0.1% extra. That's it. Right? By investing in Indian securities, that is in terms of Indian rupees. So, foreign investors will say, no, that is not sufficient for me. I will sell the securities, take the rupees, convert the rupees into dollars, take the dollars back to USA. I will get 6.5% by investing in dollar instruments. That is better for me. This is basically the argument. Okay. Let me go forward. Concept of mutual funds. Let me go forward. The idea of mutual funds. Okay. Now, point number one. Please read the statement. I'll explain it. Read the statement first. Mutual fund is a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities. Okay. Do not worry. Do not be afraid of the definition. I'll explain it, then you'll understand it. So, mutual fund is a type of investment vehicle consisting of portfolio of stocks, bonds, or other securities. Now, what do you mean by this? Let me explain it. Question number one. Can everybody see the picture that I've drawn right in the slide? Let me know. Very, very simplified version. Very, very simplified version. Do not complicate all these concepts. Keep it simple. Let's start. Imagine there are three investors, A, B, and C. There are three investors. They have money. They want to invest in stock market. What if they do not know how the stock market actually works? Simple question. What if they don't know how the stock market works? Can they directly invest and take a higher amount of risk? That is very risky. They want to invest in certain stocks. They want to invest in bonds. They know how the market works, but they do not have time for it. So don't you think there are different types of investors who for various reasons would want a help of expert to invest in the market? Correct or not? They want help from certain experts so that their investments will be done in the market. Now that expert I'm talking about is nothing but a mutual fund company. The expert that I'm referring to is nothing but a mutual fund company, MFC. Now, what the mutual fund company will do? Imagine the mutual fund company will issue an instrument. I repeat, imagine the mutual fund company, this is step one, will issue an instrument to the investors and collect money, that is investments from the investors. Any problem with step one and step two? Please do let me know right now. The mutual fund company will issue certain instruments, sell certain instruments to the investors. Those investors who have purchased the instruments will give the money to the mutual fund company. These instruments are called as mutual fund units. The instruments which are issued are called as mutual fund units. Now, next step, once the money is collected by the mutual fund company, now the mutual fund company can use the money, invest in debt instruments such as government bonds or corporate bonds. They can invest in the bond market, that is a debt market, or else they can take the money, invest in the equity market, that is in the stock market, purchase shares of various company, purchase various shares of various companies. This is how the mutual fund companies actually operate. Now let me go to the next important point. If the mutual fund company will use the money and purchase, let's say, debt instruments, can I call these as assets which are there with mutual fund company? Please participate and let me know. The mutual fund company, let's say, right, company A has taken the investments. They will purchase the debt instruments in the market. Can I call these as assets, right? Assets which are there with mutual fund company, or they will purchase equity instruments. They will purchase equity instruments and keep it with themselves. Can I also refer to these as assets held by mutual fund company? Next important point. This company, that is mutual fund company, imagine they've purchased the shares of Adani company today. Don't you think tomorrow, they might sell the shares of Adani company, purchase TCS shares? Day after tomorrow, they'll sell some of the TCS shares, purchase shares of Paytm company. After 1 week, they will sell the shares of Paytm company. They will purchase shares of Infosys company. Now, is the logic okay if I say continuously the mutual fund company will keep on managing the assets? Let me know. Is the statement making sense to all of you? Because the mutual fund company will keep on changing the composition. Whatever instruments they have purchased today, they might sell some of them tomorrow, purchase other instruments. After 1 week, some other instruments will be sold, others will be purchased. Can I say the assets are being managed by the company? And now please tell me, can I also refer to the mutual fund company as an asset management company? Let me know. Can I also call this a mutual fund company as an asset management company? Anybody has a problem why these are called as AMCs or asset management companies? Please do let me know. Anybody has a problem regarding this? Right? These are generally also referred to as asset management company. Now, next point. Let me finish up a mutual fund, then we'll take a break. Some of you are asking for break. Let me finish. Let me finish MF, then we'll take a break. Next important point. Imagine, right? Imagine the mutual fund company will purchase the shares of Adani company today. And if the only shares of Adani company are there in the asset basket for the mutual fund company, can I now say tomorrow the share value for Adani company will increase, which means the asset value will increase. Day after tomorrow, right, the shares value will fall down, which means asset value will also fall down. Any problem with this? Any problem with this statement? The value of the assets which are held by the mutual fund company, these are not constant. The value will keep on changing. From one day to the next day, the value will keep on changing. Now, you will come across a term called as a net asset value. You will come across a term called as a net asset value. Every mutual fund company at the end of the day will publish a number called as a net asset value. What is the meaning of net asset value? Whatever assets are being held by this mutual fund company on that day, after the end of the day, on that day, what is the value of these assets? Now, NAVs can keep on increasing from one day to the next day, or NAVs can also fall from one day to the next day. NAVs will keep on changing. Now, why NAVs are very important? Imagine this mutual fund company in this example. Imagine in this mutual fund company, has issued 3 mutual fund units. Okay, has issued 3 mutual fund units and has collected 100 rupee from all the 3 investors. Now, the amount of investment collected by the mutual fund company is 300. Now, think of this. Please think of this. If all the 300 rupees are used to purchase shares in the market, don't you think tomorrow this 300 rupee can become 360 rupee? Correct or not? Please do let me know. Day after tomorrow, this 360 rupees can become, 300 rupees again. It can become 250 rupees also. It can become even 50 rupees also. Possible or not? I'm not saying this will always happen like this. Possible or not? Now, please tell me, have you seen the ads of mutual fund companies? Think of it. Have you seen the ads, advertisements for mutual fund companies? And if you have seen it very carefully, they will give one statement in the ad. They will give you one statement in the ad. What is the statement? Mutual fund companies or mutual fund investments are subject to market risk. Correct? Mutual fund investments are subject to market risk. Please read the document very carefully before investing in the mutual funds. Now, what is the market risk? Can you understand it now? Let me know. What is the market risk they're talking about? Can you understand the meaning of market risk here? They are trying to tell you that there is no guarantee what will happen to your investment. Today, you might have given 100 rupee to me. Understand the next point here. Today, you might have given 100 rupee to me. I've taken that 100 rupee. I purchased the shares of, let's say, company ABC. But tomorrow what has happened? The market price of the share has taken a hit. The market price of the share has gone down. And because the market price of the share has gone down, what will happen to your investment value? It will not remain 100 rupee. It will be less than 100 rupee. It will be less than 100 rupee. And why this is important? Come to the next point here. Mutual funds are generally divided into two types. One is called as a closed mutual fund, and automatically we'll understand the next one, open mutual fund. One is called as a closed mutual fund and the second one is called as a open mutual fund. What do you mean by closed mutual fund? Imagine I'm the company. I will issue a mutual fund unit to you. I will say you cannot return the mutual fund to me for 3 years. I'll repeat the statement. I'm the mutual fund company. I will issue a mutual fund unit to you. But what is the condition? You cannot return the mutual fund unit to me for 3 years. Till 3 years, you will have to keep the unit with you. After 3 years, you come to me, give me the mutual fund, and based on the returns, based on the investment value, I will give you the money in return. Any problem with the term closed mutual fund? And there is also open mutual fund. Right? Now it is very easy for you to understand. Open mutual fund means what? At any point of time, you can bring the mutual fund to me and give it to me and take your money back. But please tell me, think of this and please tell me, if you have invested 100 rupee in an open mutual fund, if you sell this mutual fund to the company back, return the mutual fund back to the company, any guarantee regarding the money that you will get back? Think of it. Any guarantee regarding how much money you will get back? Will you get back 100 rupee plus interest? Absolutely no guarantee. Will you get 90 rupee? No guarantee. Will you get 80 rupee? No. Will you get 200 rupee? Absolutely no guarantee. What is the value on which you will get returns on that day? It is the net asset value. Correct? Please do let me know. If you have an open mutual fund, if you have purchased an open mutual fund, if you return the mutual fund to the company today, on what basis will you get the returns? That is basically on a net asset value of the company. For example, imagine this is the mutual fund that have been issued to you. How many mutual fund units are there here? Please tell me. How many mutual fund units are there in this example? Can I say 3 mutual fund units? Anybody has a problem? One has been purchased by A, another by B, another by C. Total amount of money collected, investment collected by the company is a 300. Imagine they've invested in government bonds of a 300 rupee value. Now, on the day when you go to this mutual fund company, open mutual fund, and you return the mutual fund, what if on the day the investment in government bonds, the value of government bonds has increased to 360 rupees? It has increased to 360 rupees. Now, please tell me, will you not get 120 rupees for your mutual fund unit? Yes or no? Again, will you get exactly 120? Of course, no. Right? Do not be under the impression that I will get exactly 120. No, I'll tell you why. Don't you think the mutual fund company will also collect certain charges from your investments? Think of it. Right? Don't you think the mutual fund company, which is taking a risk by investing in the market, your money, don't you think they will also take away some of the charges? Of course, yes. They will collect certain charges. Annual maintenance charges are there, that commission, this commission, tax, etc., etc. So many deductions are there. Don't worry. But now, is the logic okay? If they have taken your money and they have invested in a government bond, and the day when you return the mutual fund unit, if the value of the asset becomes 360, right, I will simply do the calculation like this. Net asset value per unit will be 360 divided by 3, that is 120 rupees per unit. This is how mutual fund market will actually work out. What if it is rather than 360? What if it has fallen down to 240 rupees? Then net asset value will be 240 per unit. It will become 80 rupees. So your investments have fallen down from 100 rupee to the value of 80 rupee. Done. This is how the mutual fund market will actually work out. Is it safe to invest in the mutual fund market? Of course, yes, it is safe. But if you're thinking of investing in a mutual fund market, do not target short term. Please always target long term. Right? Understand my statement. If you're targeting a mutual fund market, right? If your objective is I will invest today and get the money after 7 days, no. Absolutely a big no for these kind of investments. If your argument is I want to invest in the market today, I want to withdraw the money after 1 year, 2 year, 5 years, then definitely yes, mutual funds are better investments. Not the best, better investments. Done? So these are certain points. Now come back to the definition. Please read the definition and tell me, are you able to understand the definition now? A mutual fund is a type of investment vehicle. Investment vehicle means investment opportunity, which is consisting of, right, a portfolio means collection, portfolio of stocks, bonds, or other securities. Any difficulty? Point number 2, mutual funds give a small or an individual investors access to diversified, professionally managed portfolios at lower prices. Mutual funds are divided into several kinds of categories representing kinds of securities they are actually investing in. For example, there are certain mutual funds which are called as a debt mutual funds. Please tell me, if you come across a term, debt mutual fund, what is the meaning of it? Majority of the money in the debt market is there. They're investing large amount of your money, that is generally more than 70% of the money collected by the investors into the debt market. There is also equity mutual fund. There is also equity mutual fund. What do you mean by equity mutual fund? The money that you as an investor will give to the company when you purchase an equity mutual fund, majority of it will go into the equity market. So where they are investing majority of their money, that is by the company, by that logic itself, we have different types of mutual funds. Mutual funds charge annual fees, which are called as expense ratios, and in some cases commissions, which can affect the overall returns of the investors. Any problem with any of the points that I've written or explained so far, please do let me know. Otherwise, we can take a break. Any difficulties in any of the points that I've discussed now, please do let me know. Otherwise, we can take a break. Please explain second point. Mutual funds will provide a small or individual investors access to diversified, professionally managed portfolios at a lower price. What is the meaning of it? Imagine you're a small investor. Small investor means you want to invest, right? Let's say 10,000 rupees every month in the stock market. So there is an opportunity available by you, right? Where mutual funds are saying you can give your money to me. I will professionally manage your investments, but at certain charges. That is the meaning of the second point here. Okay. A fiscal deficit will increase with a decreasing credit rating. My dear, please understand. If your sovereign credit rating increases, it will become very difficult for you to borrow from the market. And because of this, what will happen is you will have to pay a higher coupon rate because risk is very higher. If you're paying a higher coupon rate, what will happen to your expenditures? Think of it, right? And both coupon rate and expenditures are both are related. Think of it. If you're paying a higher coupon rate on borrowings, what will happen to your expenditures? Don't you think that will have an impact on your expenditures? Rather than spending right here, let's say on education, rather than spending on social welfare, now you'll have to spend more money in payment of interest, which means if you want to have same amount of expenditure in case of education, healthcare, etc., now you'll be forced to borrow more. If you're borrowing more, automatically fiscal deficit will start increasing. MF AMC is equal to DII. MF AMC is equal. If you're asking domestic institutional investors, yes, and mutual fund companies in India can be referred as domestic institutional investors. Okay. How fiscal? Okay, addressed. What if any Indian investor does not want to register with SEBI but he wants to invest in Indian stock? Then he needs notes or not? My dear, did you listen to what I discussed in case of participatory note? Participatory notes, is it for domestic investors or foreign investors? Let me know. Participatory notes, is it for domestic investors or foreign investors? It is for foreign investors. Okay. Due to external borrowings in rupees, it also affects impacts inflation. Yes, it might have certain impact because of inflow of money. I've recently enrolled. Okay, I'm listening classes from batch 6. Is it necessary to listen to the weekend classes? If you're attending morning classes, attend. We are going to discuss same concept there. If you're attending weekend classes, attend weekend classes. Okay. How does a BSE and NSE different from International Bullion Exchange in Gift City? Please understand, Gift City is a concept of special economic zone. We have not discussed special economic zone. In Gift City, please understand, investments are done in foreign currency. That is non-rupee trade. Non-rupee investments are done. Non-rupee trading is done. So Gift City is a special economic zone where, right, rather than you directly investing in USA, that is in terms of dollars, you can invest in non-rupee investments in Gift City. Foreign investors can also invest in Gift City. MCX comes under which of the following? MCX is a commodity market. That is basically derivative market associated with derivative market. Okay. Done. Anything else? Anything else? Anybody else has any other question? Investment objective. Investment objective is entirely up to you. What is your investment objective? Is your investment objective returns in a longer duration or a shorter duration? Right? What is your investment objective? Higher profit, stable returns. What is the investment objective? Okay. Point number 3. Mutual funds are divided into several kinds of categories. That is, if there is a mutual fund by the name of debt mutual fund, it simply means majority of the investments are done in the debt market by the company. If it is a equity mutual fund, it simply means majority of the investments are done in equity market. Based on that, they will call this as a debt mutual fund or equity mutual fund. Right? Mutual funds will charge a certain interest. Will charge a certain, right? Will impose certain charges on the investment. Right? I said in this example, you might be right as per the calculation, you might think you will get 120 rupees. I said you will not get 120 rupees. because part of 120 is collected by the mutual fund company in the form of charges, in the form of taxation, etc., etc. That is basically the fourth point. Any other issue? Any other doubt that you people have? Are there any fixed value rate percentage for commission for MFU? It will vary from one company to another company, right? There is no one number for all the companies. It will vary from one company to another company. Okay, I've also activated live call feature. If anybody has a doubt, if they want to talk to me about any kind of doubt that they have in economics, please do let me know. Otherwise, we can take a break now. Mutual funds are non-profit institutions. Where did I say that? Did I say mutual funds are not working for profits? Did I say that? Let me know if I've said that. No, Baba. They are working for profit generation only.
Hello.
Good afternoon.
Good afternoon, sir.
Shanwas, please tell me what is the doubt?
Sir, I have one doubt
Once
regarding
again, once again. Please hold on. Yeah, go forward now.
sir,
Ah,
regarding forex reserve and external commercial borrowing and masala bond. So
okay.
as per recent report, the 80% more than two-thirds of the forex reserves is in dollar, Indian forex reserves,
Ah,
and recently our external commercial borrowing has increased 80% as per the report of previous year.
ah.
And the external borrowing whatever we got is not in masala bond. Why
Oh,
it is?
it varies. If Indian companies are not interested in borrowing from external market in terms of rupees, it is entirely left to them. You cannot force them, no. If they
sir
don't want to
it,
borrow, let them do it in foreign
sir
currencies.
sir, it is because of masala bond have specialization of character, that if we take in masala bond that I will invest in this sector, I will have to invest in this sector
Okay,
because of this or because.
that kind of restriction under ECB, that kind of restriction is applicable on all the type of borrowing. It is not just associated with masala bond. That kind of restriction is there under ECB borrowing. You cannot use it for any purpose that you want. There are restrictions under ECB. The reason, right? The reason why generally Indian companies do not utilize the ECB route now, specifically Indian rupee borrowing, is rupee depreciates. I've told you the point. Rupee
Yes.
depreciates. Indian rupee has kept on depreciating against the dollar for a very, very higher value in recent times. So if you have borrowed at $1 is equal to 50, in the last 1 year, don't you think Indian rupee has depreciated? $1 has become is equal to 60, is equal to 70, which means you're paying in terms of rupees more, right? Because of this.
Yes, sir. And so another doubt is that
Okay,
recently
before you go for it, my mistake. Uh, Foreign investors are not interested in such bonds. Not you. Foreign investors will not be interested because they will take a higher amount of risk here. Okay.
okay.
Uh,
And sir, recently the Fitch data with respect to US market
hmm.
from triple A to double A.
Ah,
Sir, and our repo rate is in around 6.50.
ah,
So, sir, why not we reduce our repo rate to brought more investment from US?
uh,
Because
hmm.
one side federal tapering is going on, interest rate is high, yield return is high, and returns is very low, narrow gap.
Hmm.
So,
So the reason why RBI has stated that they do not want to reduce interest rates is basically inflation rate. Right? RBI says inflation rate is beyond control, so we will not be able to reduce the interest rate. Even the upcoming monetary policy, I believe yesterday in Mint newspaper, there's an article regarding this. So the argument is very simple. Inflation rate in India has been on a higher level. And that is the reason RBI for the last couple of months, rather than increasing interest rates, has maintained the same steady repo rates. Reason is simple for them, inflation.
only inflation, sir.
Yes,
So, does
inflation is a concern.
okay. So, does it have any impact on investment?
Of course, yes. Interest rates will have a huge impact on investments. Even inflation
Yes,
will have a huge impact. If you're a foreign investor, if inflation is very high, don't you think your real rate of returns will be eroded?
yes. Obviously, it will erode.
That is the reason. So, inflation, interest rates, and investments, all of them are interconnected.
Sir, I have one personal question with you, sir. Please, can you
Okay.
ask me?
Yeah.
Sir, आप जो इतनी आसानी से कॉन्सेप्ट को ई कर देते हैं,
हाँ.
समझा देते हैं, कोई ट्रिक बताइए सर हम लोग को भी, ताकि आसानी से इकोनॉमिक्स समझ में आ जाए।
Okay, I'll simply tell you in one point. Every time that I teach economics, I tell the same argument. I put forward the same argument to all the students. Do not by heart. Do not read everything in detail. Understand the basic concepts through examples. Understand the basic concepts through examples. Remember examples. It will help you to remember the concepts much more easily, and try to make mind maps and try to revise through mind maps. This would be my recommendation to all of you. Try to make mind maps. It will help your life. It will make your preparation easier. If you don't trust
Yes.
me, make mind maps for 2 or 3 chapters, revise them once, revise them twice or 3 times, and then tell me, sir, your trick is useless. Then I'll tell you, use any trick that you have. So I
Oh,
simply follow this agenda. Okay,
thank you, sir. Thank
done.
you so much, sir.
Take care. Bye. So anybody else? Anybody else has a doubt regarding what we have discussed? Please do let me know. Otherwise, we can take a break now. Do Asian country not a good rating as Western countries do business? Biasness? Not necessary. Not necessary. Within Asia also many countries have got very good credit rating. Any other question? NAV value is generally in 2 or 3 digits. How these are no, how these numbers are derived? I've told you, right? How many units have been issued, how many units, that is in the denominator, and the numerator is what is the value of the asset at the end of the day. So value of the asset divided by number of mutual fund units, that is basically net asset. Net asset value is that value per unit is divided by units. Okay, done. Can we go forward? Why has been the credit rating of India so low despite a strong economy, fiscal deficit, debt to GDP ratio of India is very higher. The borrowing pressures or repayment pressure on government of India is also higher. And please understand, from one agency to another agency, methodology will change, but all of them agree that in case of India, looking at all of these features, India's rating is lowest in the investment grade. Okay, so the done. Let's take a break now. Right, a 10 minutes break. We'll take a longer break after 2 o'clock. Okay, so we'll restart the discussion at 2:22. We'll restart the discussion at 2:22 p.m. Take a break now. Okay. Am I audible? Please do let me know. Am I audible? Can we continue now? Okay. Next concept is important, slightly tricky, right? Please listen to this very carefully. Please listen first. Next concept I want to discuss is a concept of exchange traded fund. ETF, exchange traded fund. Now, what is this exchange traded fund? Let me start with a very simple example. Imagine here is an investor. Okay, imagine here is an investor. This investor, let's say, will purchase shares of a company, right? Let's say Infosys. Investor will purchase a share of, let's say, Adani company and share of, right? Let's say Paytm company. Simple example. Okay, 1, 2, and 3. This investor will purchase share of Infosys, share of Adani, and share of Paytm. This is example 1. And in example 2, the investor will purchase an instrument, and in this instrument, please understand this carefully. In this instrument, there are shares of company 1, shares of company 2, and share of company 3. Can you understand the difference between example 1 and example 2? Please do let me know. Can you understand the difference between example 1 and example 2? In example 1, you can purchase the shares of the companies individually and sell the shares of the companies individually. Whereas in example 2, the investor will purchase this instrument or sell the instrument. But this instrument will consist of shares of company 1, shares of company 2, and shares of company 3. Now, please do let me know, can I call this instrument? I'll repeat. Can I call this instrument as a basket of securities that can be traded in the stock market? Let me know. Can I call this instrument I'm talking about, can I call this instrument as a basket? Basket means group or collection. Can I call this instrument as a basket of securities that can be purchased and sold in the market? Anybody has a difficulty, please do let me know. Anybody has a difficulty, please do let me know. If this is difficult to you, imagine a very simple example. You will go to a shop, you will purchase a packet of gems. All of you have eaten gems? All of you have eaten, right, a chocolate by the name of gems? You will purchase, right, this packet of gems. Now, can I simply say, if you open this packet, you will have some of the gems which are blue colored. Some of the gems will be, right, let's say red colored. Some of the gems will be, right, let's say green colored. Correct or not? Some will be white, some will be yellow. Don't worry, right? Can I simply say, if you purchase a packet of gems and if you open it, there'll be different colors of chocolates within this gems packet. Apply the same logic to this instrument. Apply the same logic. You will purchase one instrument in the market or you will sell this instrument in the market. But this instrument consists of shares of company 1, company 2, company 3. Now, can I call this instrument as right, a basket here? Can I call this instrument as a basket of securities? At least now, any problem, right? Because in this instrument, there are multiple instruments. There are shares of company A, shares of company B, shares of company B. I'm sorry, company C. Even now, if it is difficult even now, during festivals, you'll go to a sweet shop. And have you seen this? These sweet shops, even today, they will have a collection of different savories, different sweets like this. Or in a box, they will keep sweet 1, sweet 2, sweet 3, sweet 4, sweet 5, sweet 6, 7, 8 like this. Correct or not? You will purchase this box, you will give the box to your relative, you will take the box to your home, Have you taken only one sweet in this example? Let me know. Have you taken only one sweet? No, you have taken group of sweets. Yes or no? At least now is the logic okay with all of you? So whenever you talk about exchange traded fund, whenever you talk about exchange traded fund, this is an instrument. No doubt this is an instrument. But this instrument consists of multiple securities. It is a basket of securities. And when you purchase this instrument, you will purchase multiple securities. And when you sell this instrument, you will be selling multiple securities. Such instrument is called as exchange traded fund. Point number one. Point number two. Like I've discussed this for shares. This example, I've taken this for shares of the company. Can we do a basket of securities for bonds as well? Let me know. Can we do the same thing for bonds as well? That is, let's say we will take the bonds of company A, we'll take the bond of company B, we'll take the bond of company C, and we will create one instrument. We'll call this as a bond ETF. We'll call this as a bond ETF. Now, if you purchase one of this bond ETF, you're purchasing bond of company A, B, as well as C. If you sell this bond ETF in the market, you'll be selling bond of company A, company B, as well as a company C. Any difficulty? That is basically, understand this. We can have ETF in two forms. One, we can have equity ETF. Second one, we can have bond or debt ETF. Any problem? Can we go forward? You can have one equity ETF. You can also have bond ETFs in the market. That is a debt ETFs in the market. And please understand, some of you are asking, right, these instruments are of the same company. My dear, if you're purchasing 10 shares of only Infosys, is it ETF? Tell me. Simple question. And the person who is asking this, please answer it. If you purchase the 10 shares of Infosys, is it ETF? No. What if you purchase one instrument wherein there are 10 shares of Infosys, 10 shares of Adani company, and 10 shares of Paytm company? Can I call this as equity ETF? Now tell me, can I call this instrument as equity ETF? Meaning multiple instruments, not of the same company, different companies, multiple instruments are clubbed together, are joined together to create one ETF. Right? Are created, are used to create one ETF like this. Point number two. Simple question to all of you. Point number two. Please tell me, if the market prices of the shares will start changing, will the ETF value change? Think of it. If the market price of the shares will start changing, should the ETF value also change? Does it make sense to you or not? Let me know. Does it make sense to you? If Adani, Infosys, and Paytm shares are clubbed together to create one ETF, if the share prices will change, will the ETF value change? Of course, yes, ETF value will also change. Now, can I call this as indexed investment? Indexed instrument? Yes or no? Can I call this instrument as indexed instrument? Indexed means what? Connected. The value of ETF is connected to whatever shares are present in this. Value of ETF is connected to whatever is the market price of bonds within this. If the bond prices will change, ETF value will also change. If the bond prices will fall, ETF value will also fall. So now can I call this instrument as an indexed instrument? Let me know. Can I call this instrument as an indexed instrument? Anybody has a problem? Let me know right now. Very common now in India. Very common now in India. For example, there are ETFs in the market by the name of Bank Nifty. Right? You'll get ETFs in the market by the name of Bank Nifty or CPSCs Nifty. CPSE ETF, etc. Please tell me if there is a ETF available in the market by the name of CPSE equity ETF. Let me give a very simple example. Right? Imagine you purchase an ETF which is having a name of CPSE equity ETF. What do you mean by that? Don't you think it simply means in this ETF, the shares of central public sector enterprises, the shares of central public sector enterprises are present? Correct or not? Please do let me know. Right? In this CPSE equity ETF, if you purchase this ETF, what is the meaning of it? You have purchased basically a group, right? A collection of central public sector enterprises shares in the market. Anybody has a problem in understanding this? Please do let me know right now. Otherwise, I'll go to the next one. There's a question. Is it not similar to mutual fund unit? My dear, please tell me. Very simple question. In case of mutual fund, can the assets be changed on day-to-day basis? Let me know. Some of the students are asking, this is same as mutual fund. Simple question to all of you. In mutual funds, can the company, that is a mutual fund company, can they change the composition of assets on day-to-day basis? Are Baba, very simple question. Some of you are saying no. Why? Are Baba, why? Why are you saying no? If a mutual fund company has purchased the shares of Adani company today, don't you think they might sell the shares tomorrow and purchase Infosys company shares? Is it allowed or not? Let me know. They have purchased the shares of corporate bonds today. Can they sell they have purchased the corporate bonds today. Can they sell the bonds tomorrow, purchase government bonds? Of course, yes, they can do that. On day-to-day basis, they will do that. You already forgotten what we discussed before the break. You already forgotten it. We have discussed all of this. Can they keep on making the changes in the assets? Of course, yes. But on the other side, imagine there is one ETF which consists of one share of Infosys, one share of Adani, one share of Paytm. Please tell me, can you change the composition of this ETF? Let me know. Second question to you people. You purchased one ETF, and in this ETF, there is one share of Adani company, one share of Paytm, one share of Infosys. Can you change the composition of ETF? No, you cannot change. Either you will purchase the complete ETF or you will sell the complete ETF. You are not allowed to change the composition of ETF. So don't you think mutual fund and ETF, there is a difference between both of them? At least now, please do let me know. Don't you think in case of mutual fund and ETF, there is a difference? What is the difference? In mutual funds, composition can be changed. Asset composition can be changed. But in ETF, asset composition cannot be changed. And that is the reason there is a technical term now. Mutual funds, they will say these are actively managed. I'll write it. Please remember this. These are actively managed, active investments. Whereas, right, ETF, I'll write it here. These are passive investments. These are passive investments. Passive means what? You will purchase a group of security or you will sell the group of security. And whenever the prices of these group of securities will change, your ETF will simply track the value of these securities. That's it. You cannot change the composition. Your ETF will be dependent on, right, basically what is happening to the prices of these individual securities. That is the reason they will refer to these ETFs as passive investments, whereas mutual funds are actively managed. Okay, can we go forward now? In case of ETF, I'll discuss three important concepts here, three types of ETFs. The first two are equity ETFs. These two are equity ETFs, and the third one is a debt ETF or a bond ETF. And all the three are issued by government only, so please follow them. First one is CPSE ETF. Second one is Bharat 22 ETF. Point number one for CPSE ETF. If you ask me, sir, what is the long form of CPSE? CPSE stands for Central Public Sector Enterprises. Central Public Sector Enterprises. So CPSE ETF was launched in 2014. The CPSE ETF, right, the asset management of CPSE ETF is done by Reliance Asset Management Company. Reliance Asset Management Company. And the CPSE ETF consists of 12 stocks. That is, if you purchase 1 unit of CPSE ETF, shares of 12 companies are there in one ETF. Right? So this is CPSE ETF. Second one is Bharat 22 ETF. That should be straightforward for you people. Bharat 22 ETF consists of 22 companies' securities. The Bharat 22 was launched in 2017. It will draw the shares from 6 sectors. How many companies? 22 companies. And Bharat 22 is managed by ICICI Prudential Asset Management Company. Okay. So these are two equity ETFs. Third one is a bond ETF. Third one is a bond ETF or a debt ETF. Point number one. Bharat Bond ETF was launched back in 2020 by Government of India. The Bharat Bond ETF will have a fixed maturity period. Bond means obviously there has to be a fixed maturity period. Any problem? Bond means there has to be a fixed maturity period. But if you look at this, right, there are 4 maturities. Now it has become 5 maturities. Don't worry. One is 2023, 2024, 2030, and 2031. What do you mean by 4 maturities here? How these the bond ETFs are created? Let me explain this. Follow this very carefully. Imagine, right? Follow this carefully. Imagine there is one company A, Central Public Sector Enterprise, another company B, another company C. All of them are Central Public Sector Enterprise. Let's say company A will issue bond in 2020, will have a maturity period of 7 years. Simple examples. Or rather than 7 years, let's take it as 4 years. Right? A company A will issue bonds in 2020, one with a maturity of 4 years, and the same year they will issue, right, another type of a bond, another maturity bond, which will have a maturity period of 10 years. Which will have a maturity period of 10 years. Now, company B will issue bonds, let's say in 2019, but they will have a maturity period of 5 years. Company C will issue a bond, right? Let's say in 2019, but with a maturity period of 11 years. Now, why I'm giving this example, understand this carefully. Now, follow this now. Company A, one of these bonds, one type of these bonds, can I say will mature in 2024? Anybody has a problem? The first bond will mature in 2024. Second set of bonds will mature in 2030. Company B's bonds will mature in 2024. Company C's bonds will mature in 2030. Please let me know, is there any difficulty in this? Although they have issued the bonds in different years, some of these bonds will mature in 2024. Some of them will mature in 2030. Now, please tell me, can I take this bond of company A, this bond of company B, can I call this as a ETF 2024? Let me know. Simple. I'll repeat it again. Can I take the bond of company A and bond of company B? Can I call this as a ETF 2024? Now, I hope you understand on what basis these 4 types of ETFs are given here. Second example, can I take the bond of company A and bond of company C, and can I call these 2 bonds clubbed together ETF 2030? Now, all of you are okay? Why these kind of maturities are given for bond ETFs? Let me know. Why these types of maturities are provided for bond ETFs? It simply means whatever the year when the bonds are issued, that is not important. But all of these bonds are going to mature in 2023. All of these bonds in this ETF will mature in 2024. All of these bonds in this ETF will mature in 2030 and 2031 respectively. Now, which kind of bonds can you put together? In this ETF, what kind of bonds can you put together? Can you take any bond issued by the company? No. Please remember the next point. Only the highly rated bonds of public sector companies will be chosen. What is the rating that will be parameter here? Only those bonds which will have a credit rating of AAA will be taken together, and we are going to form these kind of ETFs. Right? It holds the bonds until their maturity period, and whatever coupon rate is there, again these are reinvested only after maturity. Complete amount will be returned to you. Till the maturity of the ETF, nothing will be given to you. Upon the maturity of the ETF, complete returns are given to the investor. And these funds which are collected by issuing these bonds, the fund management will be done by Edelweiss Mutual Fund Company. The assets, that is these ETFs, will be basically be listed. The assets will be managed by Edelweiss Mutual Fund Company. Any problem with the concept of ETF, please do let me know, because we have come to the end of this chapter, that is discussion of bond market in India. Any problem with what we have discussed in the ETF, please do let me know. Right? It's a very simple logic. Please do not complicate it. ETF is a collection of securities. It is not one security. It is collection of different securities. You can take shares of different companies and club them. Then this is called as a equity ETF. Or you can take the bonds of different companies and club them. Then this is called as a debt ETF. Just like the shares, just like the bonds, even the ETFs are listed in the stock market or the bond market. You can purchase them, you can sell them. And next point is, if it is a bond ETF, whatever happens to the market prices of these bonds, that will be determining the value of ETF. Same thing is applicable to even equity ETF. With the selling or buying of an ETF, a basket of assets can be sold or bought. ETF share prices fluctuate all day, and as the ETFs are bought and sold. When the ETFs are traded, the prices will also keep on varying. These offer these offer basically a diversified portfolio. That is, diversified means different collection, different securities are put together, different shares of different companies are put together, they are given to you, or you can sell them in the market. These are the points. Same thing I've discussed. It's not that, I'm skipping the slide. Many of you simply say, sir, points in the slide are not discussed. Whatever I'm discussing, same thing I give in the form of points in the slide. What is Edelweiss Mutual Fund? Edelweiss Mutual Fund, it's a company. It's an asset management company. Don't you think there should be a company which will manage all these assets? These are assets. Don't you think all these assets, that is equity ETFs, or let's say bond ETFs, somebody has to be appointed to manage these assets, right? That is done by Edelweiss Mutual Fund Company in case of a Bharat Bond ETF. Can we go forward now? Any difficulty? Can we go forward? ETF returns is lower than the mutual fund? No, there is no guarantee. It all depends on what is the composition of ETF. It all depends from one type of ETF to another type of ETF. What is the composition? You cannot simply come to a conclusion whether it is lower or higher. Okay, let me go to the next concept now. Corporate bond market in India. What are the issues? What are the issues in the corporate bond market in India? These are certain very important points. We'll go one by one. Please listen to these very carefully. Please listen to them. Point number one. Most of the bond market in India, most of the bond market, it is basically filled up with government bonds. I'll repeat the statement. Most of the bonds in India, that is within the bond market, it is filled up with government bonds itself. Government of India issues bonds, state governments issue bond. So most of the bond market in India, it is comprised of the government bond market itself, right? So we'll simply say penetration. Penetration means what? Right, around 70% of the total bonds in India are government bonds. I'll repeat the statement. Around 70% of the total bonds in India are government bonds itself, which means only around a third of the total bonds issued in India are corporate bonds. Can I say penetration of corporate bonds in India is very, very low? Let me know. Penetration means how much of the bonds are corporate bonds. So penetration of corporate bonds is very, very low. Second one is secondary market for corporate bonds is not liquid. What do you mean by not liquid or less liquid? Understand this very carefully. You will purchase a government bond and you will also purchase corporate bond. Now, please understand this. It is very easy in India to again sell or purchase government bonds compared to corporate bonds. I'll repeat the statement. I'll repeat the statement. Listen to this carefully. You will purchase a government bond, you will purchase a corporate bond as well. It is very easy for you to sell government bonds again in the market compared to corporate bond. Now, can I say based on this, government bond secondary market is very liquid compared to corporate bonds? Let me know. We will finish the discussion on this chapter, then we'll take the break. But please participate and answer to me now. Based on this, can I say secondary market for government bonds is very, very liquid, highly liquid compared to corporate bonds? Now, if you ask me, sir, why it is very easy to sell government bonds? Because there are large number of buyers, right? Investors in the market have got very high confidence over the government of India or the state government compared to corporate sector. So in the bond market, there is a very high demand in the secondary market for government bonds compared to corporate bonds. This is a fact now. Now, please tell me, with this fact, if you have 100 rupees, will you purchase more of government bonds or corporate bonds? Will you go to the market, in the primary market, will you demand more of a government bond or a corporate bond? Don't you think you'll prefer government bonds compared to corporate bonds? Because you know you can easily sell them again in the secondary market, get the money. Illiquid secondary market, that will also prohibit demand for the corporate bond market in the primary market. Point number one. Point number three, investor base is very, very narrow. Narrow means very less number of investors prefer corporate bonds, right? Why? There is a problem with the corporate bond. What if the company does not repay? Right? I hope you understand. What if the company does not repay? Risk is very high. Right? Even individual investors such as you and me, rather than preferring in the bond market, we would prefer to invest in the equity market. The returns in the equity market is much, much better. So investor base in the corporate bond is very, very narrow. Very, very less investors. Lack of repo operations. Do you remember repo operations or reverse repo operations? Please tell me, are the corporate bonds used as security or government bonds are used as security? Let me know. Do you remember repo operation? Repo, right? Back to Reserve Bank of India, banking chapter. Please tell me, if a bank has purchased a corporate bond or and government bond, can they use corporate bond to conduct a repo operation? No, they will use government bonds to conduct the repo operation. So even in case of repo operation, there is a priority. There is more demand for government bonds, not for corporate bonds. So automatically, preference for corporate bonds would be lesser compared to government bonds. And finally, the diversity, different types of bonds are not available in India. For example, right now, understand this. Right now, we have green bond, we have a we have infrastructure bond, we have masala bond, etc. But earlier, very few types of bonds are available in Indian market. So when diversity types of bonds availability is lesser, automatically interest of the investors in such bond will also be lesser. So these are some of the reasons which have been cited by experts to prove that corporate bond market is not very well developed in India. There needs to be a promotion of corporate bond market. Now, having understood the reason why corporate bond market is not very well developed, what kind of reforms have been taken by government as well as RBI? What kind of reforms? Right? We are promoting green bonds now. Correct or wrong? Please do tell me. Are we promoting issuance of green bonds in India? Government of India is issuing green bonds. NHAI is issuing green bonds. Right? Banks are issuing green bonds. Private sector companies are allowed to issue green bonds. Point number two, masala bonds are promoted under ECB. Under ECB, masala bonds are promoted. Again, the answer is yes. Additional tier 1 bond, tier 2 bond, right? Again, these are from private sector. What about infrastructure bond? Let me know. Did you read the article that I had given last week on the concept of infrastructure bond? Let me see how many of you have read it. Did I give you an article regarding infrastructure bond last week? Please answer, reply. Have I given it or not given it? As far as I know, I've given it. I'll tell you the point also. State Bank of India, SBI, has issued an infrastructure bond which has a maturity period of 15 years. If you have not read it, please do read it. Please do read it. Right? Then what is the point of me giving articles to you and you not reading it? Right? I'm asking this question seriously to some of the students who have said, sir, I did not read it. Then why do you collect it? Let me know. Why do you collect it? You want to become a district collector or some other collector? Right? Then there is no point in me sitting every day collecting articles for you people, right? To give it to you, you will download and keep it with yourself. For what purpose? I absolutely have no idea. I absolutely have no idea. For what purpose? You will collect it, collect it, collect it, collect it, collect it. Just like newspapers that you're collecting, Yojana magazine that you are collecting, India yearbook that you are collecting, right? Different articles that you are collecting. No point in collecting, my dear. Read it. So now can I simply say, in recent times, different types of bonds are being promoted in India. Yes or no? Because one of the concern regarding corporate bond market was different types of bonds are not being issued in India. Different types of bonds are not being issued in India. So now have a look at it. Government of India as well as Reserve Bank of India, they are promoting, right, different types of bonds in the domestic market. Now, there is one more reform that was taken by Reserve Bank of India, TLTRO. One more important reform, TLTRO, targeted long-term repo operation. Targeted long-term repo operation. Now, what is this targeted long-term repo operation? Let me explain it. Here is the Reserve Bank of India. Under this facility, the banks are allowed to borrow from 1 year to 3 years from Reserve Bank of India. Point number one. Under the targeted long-term repo operation, the banks are allowed to borrow for 1 to 3 years from Reserve Bank of India. But now, this money that has been taken by the bank from RBI, borrowing that has been done by the bank from RBI, the bank will have to use it to purchase investment grade corporate bonds from the market. The banks will have to use this amount of money to purchase investment grade corporate bonds from the market. And on this amount of loan that has been taken under this facility, RBI will charge repo rate for the bank. Now, please tell me, point number one. Under this facility, if a bank takes a loan from RBI, will the demand for corporate bonds increase or not? Think of it. Point number one, under this facility, if the banks will take a loan from RBI, will the demand for corporate bonds increase or not? Arey Baba, answer. None of you are answering now. None of you are answering. Sir, I'm sleeping. Sir, I'm having lunch. Don't disturb me. Right, sir, I'm watching a movie. Please do not disturb me. Right, so if the banks will take loan from RBI to purchase investment grade corporate bonds, will the demand for corporate bonds increase or not? Some of you are answering no. Why? Why? What is your argument? What is your reason? You please tell me. If you are a bank, I'm RBI, I will give you 50,000 crore rupees under TLTRO. But condition is what? You'll have to use this 50,000 crore rupee only to purchase corporate bonds. What kind of corporate bonds? Investment grade corporate bonds, not any bond. Investment grade corporate bond. Now, if you take a loan, will it lead to higher demand for corporate bonds? Of course, yes. Right? Don't you think this will promote growth of corporate bond, development of corporate bond market in India? Right? Again, the answer is yes. So this tool, right? This tool is called as TLTRO. Right? This tool is referred to as a TLTRO. Anybody has a problem with this? Why RBI is not purchasing the bonds directly? My dear, Section 17 of RBI Act of 1934. Have you come across Section 17 earlier in the classroom? Let me know. And this is where the importance of the previous lectures will come. Section 17 of RBI Act of 1934. Please open the chapter, that is, let's say, PPT for RBI. Check, there is one section that I've listed, and it talks about what is the function, what is the investment done by Reserve Bank of India. Reserve Bank of India is not allowed to invest in these kind of instruments. RBI is allowed to invest in government securities. RBI is allowed to invest in state development loans. RBI is allowed to invest in treasury bills, invest in gold, invest in foreign currencies, invest in foreign government bonds. RBI cannot directly intervene in the corporate bond. Right? They are not allowed to do that. Section 17. So targeted long-term repo operations has been done by RBI in order to ensure there is a liquidity in the corporate bond market. RBI wants the banks to borrow under this window. Window means facility, to invest only in investment grade corporate bonds. That is, investment grade means what? Do you remember that? Anything above triple B or anything above BAA3. Very simple. Anything above triple B or BAA3 credit rating. It will help in creating liquidity in the corporate bond market. Done? Any difficulty in the TLTRO? Let me know. Anybody finds TLTRO is difficult, any point is difficult, please do let me know. So these are some of the reforms which have been taken in recent times to promote a development of bond market in India. Government bond, there is no issue. I hope you understand. Government bond, there is no issue. Government will sell lot of bonds, raise a lot of money from the market, and there will always be demand for government bonds. Because basically the argument is government of India is more credible in the market. It has never defaulted on the repayment. People will be interested, investors will be interested. But there is a problem regarding corporate bond. Corporate bond we need to promote. That is the reason we are implementing various reforms to promote corporate bond market. Now, those who are saying repeat TLTRO, tell me what is the point there is a problem for you. After discussing 10 minutes, don't say repeat the whole thing. Tell me where do you find there is difficulty. Tell me that point. It simply shows that you are not listening to the class carefully. Right? It is your duty to listen to the class very carefully. If I'm not teaching, let me know. But you don't simply say after the whole thing is over, don't come and say repeat the whole thing. That is not the right way. Where is the problem? Tell me that. Because it's a very simple process. Bank will take a loan from RBI, use the money to purchase corporate bonds. What is the difficulty in this? You tell me. Tell me what is the difficulty? I'm saying bank will take a loan from RBI where the loan will be given for 1 to 3 years, use the money and purchase corporate bonds in the market. What is the difficulty in this? What is the difficulty? If banks will keep on purchasing bonds in the market, tell me, will the demand for corporate bonds increase or not? Let me know. Will the demand for corporate bonds increase or not? Will there be more buyers for corporate bonds in the market with this? If more and more buyers are there in the market, don't you think what was the issue earlier? What was the issue earlier? We are trying to address the issue of corporate bond market. Yes or no? What was the issue earlier? Right, we are trying to address the same issues of corporate bond market. Liquidity in the bond market automatically will increase. Right, that is a point. Right, so this is advice to some of the students. Right, please listen to the lecture carefully. Please listen. If there is a problem with the point, you can tell me. But when I'm explaining, taking 10 minutes, taking examples and explaining, don't come and say, repeat the whole thing. Then it defeats the whole purpose. Okay? Done? Any other issue? Can we use these in answers? Of course, yes. Use it. What is the problem? Use this. Whatever I discuss, except sometimes when I say don't write it, use whatever is there in the slide in writing the answers. Absolutely nothing wrong. Anything else? Can we go forward? Corporate tax rate cut is connected to this? No. As far as I know, no. There is no connection to TLTRO as corporate tax rate, corporate tax rate reduction. Any other problem? Any other concern? Because this is the end of the chapter. This is the end of the chapter. After this, questions are there, right? This is the end of the chapter. Third point in TLTRO. My goodness. How many times should I repeat it? RBI wants the banks to invest in those instruments which will have investment grade rating. My dear, the student was asking third point. Tell me, what do you mean by investment grade in a bond market? Tell me. Because, right, this we have discussed. You cannot simply say, sir, you did not discuss what is the investment grade earlier. If that is the argument, let me know. Right? What do you mean by investment grade? What do you mean by investment grade? Already forgotten. Investment grade simply means any instrument which will have a credit rating of BAA3 or triple B and above. Yes or no? Right? Any instruments in the market which has a triple B or BAA3 or above rating. So RBI says the money that you have taken under TLTRO, you cannot use it to purchase a corporate bond with a junk grade. You will have to invest it and purchase only those corporate bonds which have investment grade. Very simple argument. Okay, done. Anything else? Anything else? Please listen to the lecture carefully. Please listen to the lecture very carefully. Illiquid means demand and supply is very less. There are no buyers, there are less buyers or no buyers for these kinds of instrument. Okay, can we go forward now? Anybody has a question regarding what I'm discussing? I've activated the call feature. If there is any issue, please do let me know. Otherwise, we'll take a break, lunch break now. Any issue? Anybody has a doubt, please do let me know. Otherwise, I'll stop the session. We can take a break now. What is gold ETF? Simple. Gold, right? ETF where gold is tracked. It's a very simple idea. Annotations of certain lectures, please write a mail. I will also inform the concerned team to upload that lecture. Don't worry. Done then. So let's take a break then. Let's take a break. So we'll take a break. 3:40. Okay. So we'll restart the discussion. We'll restart the discussion at 3:50. We'll restart the discussion at 3:50. 40 minutes break. Take a 40 minutes break. We'll restart the discussion at 3:50. Okay. Take a break.